Morning, everybody. It's 10 o'clock exactly. I feel like a newsreader. I probably shouldn't say that at the moment, should I? Morning and welcome to the latest edition of the Specialist Mortgage Web Show. If you haven't attended one of our shows before, I'm going to introduce myself now. For those of you that have been, obviously you know who I am. My name's Tony Sutton, MD of Specialist Financial Services. I'm your host for today. Okay, so a little bit on all the speakers, as always. We do a little bio, so you know who you're talking or who's talking to you, and a little bit about them. So this is all going all the way back to the early 1980s. I had 6 years with a specialist lender that was involved in the second charge and commercial areas, which I did both of those. And I then became a broker for a short while, working for somebody else. I set up my first company 34 years ago at the age of 25 on the 11th of May 1989. Grew that from a two-man operation to having at one stage 141 staff at its absolute peak, but had a major fallout with my ex-business partner in 2001, 2002, 2003 and 2004, and then decided in 2004 I had enough of it and left to set up by myself and set up Specialist Financial Services. Traded very, very successfully for 4 years until the crash took all the lenders away, as those of you that were around at the time will probably remember, and basically wasn't really writing any business. Stayed with the market though, because I really don't know anything else. Excuse me, I've got a very itchy nose this morning. Stayed with the market, and 20th September 2023, which is what now, less or just over 2 months, 40 years in the market, which I probably won't celebrate after a couple of the phone calls I've had just this morning with lenders that I sometimes lose the will to live. But 40 years in the specialist market. So there you go, that's me. We also give a little bit of a claim to fame. I'm not sure if this is really a claim to fame because this was never published, but it's maybe famous in my family at least, and some of their friends. My hobby is cooking. I've always found after a hard day in the office, speaking to lenders, slamming the phone down on lenders sometimes, having to speak with solicitors, surveyors, and all the other depressing things that we do. I like to go home and cook, quite simply. And I've made up loads and loads of recipes over the years, a few of which are actually my kids' favourite dinners. And they still, if they come over on their birthdays, we say to them, "What would you want to eat?" Is, "Can I have Dad's so-and-so?" So I was being nagged for years. You should do a cookbook. And didn't really think anything of it. And then my son-in-law, who married my daughter in 2019, said, "Tony, you should do a cookbook before you die," which I thought was a little bit harsh, but he sort of like that rammed it home. So I did exactly that. So I gave it to my kids as a Christmas present. So I couldn't really think of anything else to give them, and they absolutely loved it. So I've been adding to that ever since. That was about 5-6 years ago, I believe. Adding to it ever since with new recipes, and they've even had their friends and other members of their families, the extended families, have taken copies of it. And now I should have published the bloody thing. Would have made some money out of it, maybe. But so there you go. My claim to fame, but it's only within my own family. Okay, so our sponsor this month is big thanks to Lendco, who are also our first speaker, who are the best lender you've never heard of, which I think is a phrase I originally came up with, but only internally. But then they started using it as well. So, but it describes them perfectly, and as you're going to find out fairly soon. If you can't hear or see us, just go to the type your message in the bottom corner. Hopefully everyone can, because there's been no comments so far to say, "Oh, we can't hear you." I've got a brand new microphone that I bought because my old microphone, we wore it out after about 60 of these shows. So it's brand new. So hopefully it won't, it's one of Amazon's finest. So it hopefully shouldn't break down or anything go wrong with it. If you are using Internet Explorer, I don't think anyone does these days. I'm pretty sure there's not support for it, but just in case you are, switch as soon as you can to Chrome or Firefox or Edge, because it will stop working, because it's not fit for purpose anymore. And we are very much not just dependent on outsourced technology this month, because obviously things like Wi-Fi go down. My head of IT is currently working from Stevenage, which is about 50 miles away from here, because he is unable to drive at the moment because of a medical condition. So he's actually managing this remotely. So we've never done this before. He's always been next door. So if there's a problem, he can run in and get it sorted. Well, he's not running anywhere at the moment. So if it goes wrong, it's down to me. My knowledge of IT could be written on a postage stamp. We're just about to switch on a computer sometimes. If you have a question, go to, again, type your message box in the bottom corner. We'll try to get to the questions in the time, all the questions in the time we have. If the question's obviously already been answered within the presentation, we'll just cover it off very quickly. But please, as many questions as you can. Today's specialist, there's a little picture of who you can expect to see. No women this month at all. There was due to be one, but she's been obviously couldn't make it for some reason. So the brothers are doing it for themselves this month. So let's see how they get on. I'm sure they're all going to be absolutely fine. All of these have actually, except for one, have all presented before. The one who hasn't, I've spoken to many times, and I know he's going to be absolutely great. And just so you know, you might recognize the logos a little bit better. Lendco, Redwood, West One, and Tuscan Capital. And today's objective, and this is where I've decided to make a change from this month, because I was tending to find I was saying the same old thing month after month, and I wasn't able to look at the screen very much. So I decided to make some changes. So what we're going to be doing is, you see this, if you've attended one of the shows before, you see the screen has changed. Obviously, you want to attain a more detailed knowledge of different lenders within specialist finance. Well, what we're doing this month, you see the ones that are highlighted in orange. At the end of today, after the lender speakers have spoken, I will be speaking about these subjects. So buy-to-let second charges, regulated second charges, and regulated bridging. The speakers today will be covering buy-to-let first charges, commercial mortgages, regulated first charges, and unregulated bridging, which pretty much, other than development finance, is what we do. Pretty much. I mean, that covers everything pretty much we do. First time we've ever tried it, and I was writing the slides at 2 o'clock this morning. So I have checked them, but no doubt there will be mistakes and it will probably all go wrong. But let's wait and see. We want to provide some ideas and tips for generating more business for you, as well as protecting your customer base from others. And that's something I'm always going to be going on about, because of this disgraceful behaviour of some lenders in the marketplace. And also information on future training and knowledge webinars that we run, which are proven to be very useful. And I'll be covering those, I think, in a moment, possibly in a moment. I'm going to see in a second. Each presentation from the lenders lasts 20 minutes, 10-minute Q&A after each session. And the speakers have set themselves questions, just in case you don't ask any. So don't give them an easy ride. Please ask the questions. If there's anything you come across, there isn't such a thing as a stupid question when it comes to what we do. Ask away, ask as much as you want. So don't give them that easy ride where they're actually answering something they've actually written themselves. I've never come across one yet who couldn't answer something they've written themselves, but I'm sure one day it will happen. Okay, feedback questionnaire will be sent to you automatically available at the end of today's show. We've changed the way that happens, and it will ask questions about today's show, what you'd like us to change. We always take on board. We did get 2 comments last month saying, Tony, could you change your script because you keep saying the same thing? So I've done exactly that. I ask you to rate each speaker as well. That's also very important. If there is a speaker who's having an off day, let us know. Let us know what you think, because we do need to know. We don't want to be inviting people back who are not popular. But as I say, everyone who's on today has presented before us. And you will be emailed your CPD certificate by 5:30 tomorrow. That should almost certainly happen, because my head of IT who does it is, let's say, working from Stevenage. Please check your spam folder if not received. A little bit about some of the shows we've got coming up, just promoting these. We've got on the 27th of July, one of our Sutton and the Specialists, which is with the Family Building Society. And we'll be talking about, amongst other things, joint borrower sole proprietor mortgages, family mortgages, hence the name of the lender, but where family can help out with deposits. They can help out with all sorts of stuff. So we'll be covering quite a bit on that. And I'd probably say at the moment, with the way things are, and just reading the press this morning, I'm going to have to maybe block all these press stories, because it's as depressing as it can possibly ever get at the moment, with the mortgage market just collapsing. I think I've seen this morning, with new inquiries, approvals. So this could be very, very useful. So that's the first one. We then got a follow-up. For those of you who saw Roger Morris back it was March, and he was talking about the reimagining the mortgage process, and we briefly touched on EPCs. And Roger is probably the most knowledgeable person. If you know Roger, he's the most knowledgeable person in the industry regarding EPCs, because he's a very, very big property landlord himself, and is currently being used by the government to pilot certain schemes and certain things. So he has the inside track on what's going on, because there's a lot of misinformation out there at the moment. And some of the lenders are putting out that misinformation really should know better. They really should. So you can register that. Then we'll show you how to do that at the end of today's show, how to register for that. But it's all available on our website as well. And then on the 25th of October, I'm having a break in September. I'm going on holiday. 25th of October, we are doing the post-consumer duty. Now, for those of you who attended this one with Robert Sinclair back at the end of May, it was our most successful show by a country mile. We've literally had many hundreds of people have now watched the show either on the day or on catch-up on our YouTube channel, believe I'm saying that we've got a YouTube channel. But what it was so successful, and Robert enjoyed it so much that he asked if he could do a post Consumer Duty show. So after the 31st of July, let me just switch my phone off, which I've forgotten to do. Apologies. After the 31st of July, when you're all sitting there thinking, what was all that about? Well, he's going to be saying basically what's happened. I will just say on Consumer Duty, I read recently that it's estimated that about 70% of lenders may not be ready. Increase that number to about 99.99%. Some of the conversations I've had this week with lenders, they've got staff that I honestly would not employ to make the tea in our office because they are just horrendously bad. I've had a conversation this morning with somebody who doesn't even bear thinking about, and that's what we're having to actually deal with as the middleman between a lender and our clients. Is absolutely, if we employed staff that some of our lenders employ, we would be put out of business, quite simply, because it is atrocious. It's just like filling seats sometimes with people who really shouldn't be doing the job. But anyway, that's my moan over on Consumer Duty so far. So that's our follow-up. Again, you can register at the end of today's show, but that one was extremely popular. I mean, we had something like 3 or 4 times the normal amount of sign-ups that we have for any of our shows just for that particular one back in May. So should be very interesting. Okay, you've also been sent today. This actually was issued yesterday. I wanted to follow the previous slide because it was actually issued by in association with Amy and Imla. And you might not have seen this. You may have seen it. If you have seen it, then you've got it again because we've sent it to you this morning. Which was a better understanding of what's going on in the market at the moment and how lenders are pricing their rates and what's happening with rates being withdrawn at very short notice. I mean, I'm a little bit sick to death. Some lenders email us at 3 o'clock and saying we're withdrawing our products at 3:15. That I think is disgraceful. You need a little bit more little bit more notice than that. But their excuse is quite simply, well, we can't be losing money. Well, maybe what you should do is issue your bloody press releases at 9 o'clock rather than 3 o'clock, so that we're not all running around like headless chickens trying to get deals on the system that then crashes and then the client is put out of pocket. That's not treating customers fairly. That's not fulfilling your duties under Consumer Duty. I guarantee they'll still be doing it once on the 1st of August. And it's got to stop. But have a read of this because it is very, very useful. It can maybe help. It's something you can even use parts of it to send over to your clients to help them understand what's going on. Because clients don't understand. They haven't got a clue what's happening at the moment. They just see base rates and they just see, well, base rate hasn't changed because they don't understand the way it works. Our updated guide is available for what we pay you, what we receive and what we pay you. Again, you can access from the website, or we'll show you how to access it literally immediately at the end of today's show. And I've just actually had somebody comment, which I'm going to come back on in a moment, in the chat. So retaining customers, I've been talking about this all since we did our very first show all the way back in June 2017, because of some of the horrendous things we've come across over the years. Lenders phoning clients on the day of completion and saying, next time you want to borrow money, come to us direct, you won't pay a broker fee. That's one. Contacting clients every 2 months saying, would you like a further advance, and not advising us or our broker partner, and then just doing the loan and just quite merrily, making money on our clients. Has to stop. Quite simply, this is what we've been doing ever since GDPR came out. No marketing contact. Write it across, if the client gives you the permission to do so, across the marketing part of the document that lender issues. If they take notice of it, which probably some of them won't, then it might stop them pinching your clients. It's something we do now on every single case that we possibly can. GDPR, I've really scaling this down now because GDPR is over 5 years old since it came out, but there's still probably 50% of you that haven't really done anything at all. These are also still available. Again, you can see, you can download these from the website or at the end of today's show. And these just help you show anybody that comes into your office, should anything ever go wrong, like you get hacked and you have to call the Information Commissioner's Office and the FCA, at least I did something. There you go. This is what I did, rather than doing nothing at all. These are still available, but I'm not going to talk too much about GDPR anymore. First presentation is about to start. Get yourself comfortable. I'm just going to say, J. Debbie, thank you very much. I did enjoy my anniversary. I also very much enjoyed my 60th birthday. I was supposed to be going away to Paris, but I had to cancel it because on my son's stag, my son gets married next week, and on his stag, I was playing shock football and ruptured my groin muscle. so I was unable to walk. So we had to cancel our Paris trip, which is probably just as well. I was in a doghouse for about 3 days, but then the riot started, and then my wife thought I could see into the future. So, but everything. So I've got my last of the things that we are celebrating is going to be on Saturday week, which is my son's wedding, and then I'm going to relax for a while because it's been an absolutely crazy 6 weeks. So we are now about to move on to our first speaker, and I'm just hoping, so I'm going to talk very slowly. There is a lot to go through today, but I'm going to just go through his introduction very slowly. Now, you've all been sent as we always do, the lender criteria, but for two lenders today, we haven't, quite simply because they've changed pretty much overnight and they haven't issued their new stuff yet. And the first speaker, his company Lendco, is one of them. So we're just waiting on their stuff to come over. And Graham's there. Graham, I hope you can hear us. We can see you.
Yeah, good morning, Tony. How you doing? You right?
Yeah, really good, thanks. Really good.
Good.
Let's crack on. So next speaker, Graham Palmer from Lendco. And he looks just the same as he does in his picture. So he's not used a picture from about 10 years ago or anything like that, like some people do, like I do actually, or used to. Yeah, oh, good. So a little bit on Graham, first of all. He's been at Lendco since April 2021, previously a mortgage advisor and broker in both the regulated and unregulated markets. Graham has a great picture of what's important on both sides of the fence. That is actually really important when you've done broking and lending, because you do have that vision of you know, how things work. Sometimes I think lenders just think brokers sit there counting money all day. Believe me, we don't. Graham started in the world of mortgages as an advisor for Lloyds Bank back in 2015. He found himself in the intermediary market a few years later. This is where he started to fully appreciate the importance of a quick and accessible BDM and strives to be just that. Outside of work, Graham enjoys spending time with his family and friends and attempts to squeeze in the odd game of golf in at the weekend, although he will admit that since his 3-year-old turned up, his handicap has gone the same way. I'm not going to talk about golf. I was officially the world's worst golfer. His claim to fame, we've got some great claims to fame, by the way, today. Very, very diverse claims to fame as well. Graham once found himself in a position where he was backstage at a festival raving away with the Chuckle Brothers from the historical BBC children's show Chuckle Vision. That's right, the To Me, To You chaps. There you go. Correct. So I'm just wondering about raving, but what festival was it?
It was the Isle of Wight Festival at the time. So a friend of mine's sister's friend of I don't know, some faraway connection managed to get us backstage tickets, which was wonderful and a great experience. But yeah, just happened to be there at the time with my what is my wife now and was girlfriend at the time, and we looked to our right and there was Paul Chuckle dancing away to the evening. So yeah, he was having a lovely time, and yeah, it was just great fun.
Of all the famous people you could have met and been raving with, it was actually the Chuckle Brothers. So
a random one at best. Absolutely, yes.
Absolutely. Yeah. Graham, over to you. See you in about 20 minutes. Good luck.
Yeah. Brilliant. Yeah, no, thanks, Tony. Thank you very much, and thanks for having us on again as well. Really appreciate it. So it's always lovely to come back and talk to you guys. I mean, where do we start at the moment in this current market, right? I'm going to be talking to you today about complex buy-to-lets, but as we all know, it's been a bit of a toughie over the last 18 months, to say the least. Some varying rates, and I know Tony sort of touched upon probably where your mindset as brokers are at the moment, with regards to how frustrating it must be when lenders are there 1 minute and gone the next. So obviously, I don't want to sound like I'm defending all the lenders here, but obviously from our side of things, it's been a particularly volatile market right now, you know, and it is very difficult sometimes to foresee what's happening day to day, let alone what's happening week to week or month to month right now. So it really is a case of you come in one morning and the dynamic of everything's completely changed. So yeah, it's tough for everybody, and we do obviously appreciate the support you guys give us, and we love the fact that obviously you still keep coming back with inquiries and questions even throughout that period of time. And right now, we are one of the two lenders that don't currently have anything on the fixed rate side of things out and about at the moment. So our guys have taken them off the market just to get a bit of an idea. Probably towards the end of this week, maybe early part of next week, and we're due to be back into the market again, hopefully. So yeah, I'll follow up if that's okay, and obviously send out some product guides and some information about what our new offering is going to be. But yeah, so obviously what we can still do though, and we are still available for, is our tracker facilities we have available, which obviously offers a variable option for the client right now. And also we've also got a bridging facility as well. So we've seen a massive increase in our bridging side of things right now. It's kind of timed nicely actually for us, because that's sort of fallen into a time where we've just released a new bridging facility as well. So we've got a whole new set of criteria. available to us, which allows us now to obviously fund for works and obviously lend much significantly larger sizes as well. So yeah, our bridging facilities is looking really, really strong. And obviously with fixed rates, that's great as well right now. So what I'll do again is I'll follow up and send that out at a later stage, but don't want to be treading on other people's toes. So complex buy-to-let, where we're at. So, and if you may not have even heard of us at this point, to be fair, so Lendco are still one of those kind of just up and coming still at the moment. We used to be classed as the best lender you've never heard of, but I think we're probably now in the region of the best lender you might have heard of at this point. So yeah, let's see how we go. From our side of things, what we can offer you, or what I'm hoping you're going to take away today, a little bit about us as a company. Obviously, what we can offer out there in the current markets and the way it's currently going. A little bit of in-depth detail about HMOs and multi-units. That's obviously what we looked at last time around, and I'll just do that again this time around as well, just to make sure that offering is still there and available. And obviously a little bit about our ownership structures that we can support as well, because it's another area that we're particularly strong on right now. And obviously, if there's any other queries or questions at the end, please feel free to fire at me. We always love to go through some of the questions you guys have got, of course. So yeah. So on to the next one. Who are we? So best, see what I said there? I haven't changed that at the top. Best specialist lender you've never heard of. So we were established in 2018, the summer of 2018, did our first deal towards the end of 2018. And since then, we've been able to generate over about £1.4 billion worth of lending out there. So, you know, we know our stuff, we know what we're doing. And yeah, we've had great success in quite a short period of time, especially when you consider the fact that we've been going through obviously this economic situation we've had over the last 18 months. And prior to that, COVID, of course, as well, which wasn't very helpful. So yeah, we've done well in what we've got. We specialize in buy-to-let. Standard stuff, you know, we look at standard buy-to-let units, and we also look at obviously HMOs, multi-units, new builds, quite a strong range of what we can actually offer on that side of things, along with holiday lets and supporting foreign nationals and expats in there as well. So, I mean, it's quite a big mix. For us, though, obviously, what we try and do in all those cases, in all situations, is just try and use some common sense. That's what we want to do. So common sense lending is key for us and our sort of our long-term picture. We take on everything that we do. We take it back to our credit team if there's anything just a little bit unusual about it. We have a talk through it, and we'll obviously get back to you with an answer within 24 hours at the latest. So every morning at 10 o'clock, we have a credit call, and that allows us to then have those kind of conversations with directors, heads and senior underwriters, head of credit risk, etc. as well. So, you know, when we say yes and we say no, we normally give you a very strong answer from day one. And that's kind of what it's all about. If we can't say yes, let's give you a quick no. Second best answer I can possibly give you. So we lend in England and Wales only. And we have a team of about 35 of us at the moment. So, yeah, they've been in the market for quite some time, most of them as well, bless them, with various other lenders as well, which is great. And all from the specialist market in most cases as well. So that allows us, again, to have a great diverse sort of look at how other companies have taken on their sort of risk mindset. And it just obviously mingles together with us as a great team. So we've quietly been growing our distribution panel over the last few years. Last year, we were about the 160 mark, but we've really ramped up this year and over the last 12, 18 months again to sort of push out and try and get ourselves known out there. So yeah, we're at about 450 broker firms now. So yeah, fantastic support. And hence why I say now you may have heard of us rather than not have heard of us. So, you know, our director would be remiss if I didn't mention the fact that we do everything with a can-do mentality. So that's his favorite catchphrase. But yeah, can-do is the way. And it is, you know, genuinely is, you know, as I said, what Tony kindly said at the beginning, you know, I've previously been a broker myself. I understand where the challenges are, and I understand obviously what you're trying to achieve as quickly as possible. So, you know, from my side of things, if you come to me with a quick query or question, you know, we'll go away with it. We'll have a look at some common sense. If it doesn't quite fit the mold, we can still try and make it work in most cases. So, yeah, we always appreciate you just giving us a shout in all cases and see what we can do for you. So, I'll pop that up there just because it's a very nice little quotation from one of our brokers that we were dealing with a little while ago. So, yeah, from our side of things, it's always nice to have a bit of a pat on the back, isn't it? So, moving swiftly on. So we have a team of about 35 to 38 people now. So actually we included a few new people recently as well. So, and that's just an overview. So if anyone's interested in that side of things, I know that the slides get sent out, of course, as well. So please feel free to have a look through that as part of the team there. But I work with Alex King and two other the BDMs that we have here, Ben Pike and James Phillips. And obviously as a team, we work together as a team. So we're not based regionally. We're not based sort of in certain postcodes and that kind of stuff at all. We felt that it was better for us that if, you know, one of us was away, for instance, that there's an incentive for the other guys to want to pick up the phone and help you guys out, which is, again, key. So you don't have to worry about us fighting over particular deals or fighting over sort of patches of area. So nice and easy. So Okay, so what do we do? So property types, as I mentioned earlier, standard units, HMOs, multi-units, above and adjacent to commercial. So again, I appreciate that's going to be quite a tricky one sometimes to place for some lenders. The only things we can't do in that basis is really pubs, nightclubs, takeaways, bars, anything sort of a liquor license really there. So that's a bit of a no-no for us. But otherwise, yeah, if you've got properties that are above or adjacent to the commercial, then we can have a look at that up to 65% loan to value. Now, if it's directly above or adjacent to, if you've got a unit that's maybe 2 or 3 stories up in a block of flats, for instance, then obviously, as long as the value of comments come back is quite strong, we can even look at that up to 75%. So the commercial downstairs won't have much of an impact or something in that basis there. So, and obviously from our side of things, we only deal with residential and we only deal with the bridging side of things there. So we don't look at anything that's on a commercial basis term-wise. So we can do commercial on a bridging basis, but we can't do it on a term basis wise. So if you have got a semi-commercial unit, the one thing that we've been successful with is sometimes if it's the right thing for the client, splitting the titles and obviously having a look at the unit again above the commercial. If they want to finance the whole facility, probably honest answer is not one for us. Yeah, so in those situations. PD projects, guys and girls who like to go out there and look at big office blocks and just turn them into housing nowadays. It seems to be quite popular. We're open to looking at those sort of scenarios there. Obviously ex-local authority housing as well, new builds and holiday lets as well there. So just to give you a heads up, holiday lets and new builds both at 75% loan to value, and the ex-local authority housing would be 65%. And that one is a little bit case by case. We haven't really got any sort of definitive yeses or nos in certain circumstances there. But yeah, feel free again just to pick the phone up to one of us free and we'll run through that with you anytime you want in that situation. Our application times at the moment, generally, I've put there 20 days from application to offer. That is correct. If it comes in with a full application, we're a little bit quieter, we can do that side of things, no problems at all. If we're at peak capacity, I've known us to sort of take up to about 30, 32 days. So it's still not horrendous, I must admit, and we'll keep engaging with yourselves about sort of the timescales and that when we go through these cases. You actually get given a dedicated case manager and an underwriter when you go through every case as well, which we give you access to. So we always feel that that's obviously quite important as well. You don't want to keep phoning me to go through somebody else, at a later stage. If you want to just pick the phone up or email the underwriters when you're going through a case, we love that. No problems at all in that situation. So, and everything that we do, of course, is online and all based with electronic signatures, etc. as well. So again, nice and easy, no paper sort of manual sort of forms to be filling out nowadays as well. So, but yeah, so nice and straightforward. Use the system, process it through, automatically sends out the documents to the clients as well. So nothing for you to have to do in that situation. Okay. So one of the things I said I was going to mention through today a little bit more in detail was the HMO side. So for us at the moment, HMOs, we can look at properties up to 8 bedrooms as a maximum at the moment. We stress that at either 125 or 145, depending on the client situation. So there's a little grid at the bottom there. But to give you a heads up, obviously from our side of things, it's lower rate personal name taxpayers and limited companies, SPVs, trusts, LLPs, anything like that, for instance, that would all be at 125. So that's the easiest stress there. No first-time landlords, I'm afraid. So from that side of things, we do expect some of our clients to have a little bit of experience in the market and to know what they're doing with buy-to-lets. Normally require them to have at least one for 12 months as a sort of a running theme. But again, there's been certain circumstances where maybe the client got rid of their buy-to-lets a few years ago, but used to run a portfolio of them or something, for instance, and now wants to start back up again or something. And again, we wouldn't sort of just, say no to that just because they haven't got a buy-to-let in their name right now. So again, it's the kind of sort of common sense stuff you'd have to look at there. We go up to 75% on HMOs. And if they are maybe getting their very first time HMO, we might sometimes look at that at 70%, just to sort of just make sure we sort of cut them down a little bit, give them some support there. But yeah, from our side of things, obviously we're in a position where, sorry, just reading this, we've got 2 single units for 12 months. We can do it with 1, so that's fine. I've just changed that. So, but yeah, we have a specialist panel as well that we use for our HMO instructions. So we use VAS. Or appraisers in some circumstances. Normally your larger HMOs, we're going to be looking to use the VAS panel in that situation, and they come back to us with 2 or 3 quotes for who's going to be the quickest, who's going to be the cheapest, etc. as well. So and we ask those guys what's the best kind of valuation based on the property unit out there as well. So really nice and straightforward. We just go to those guys and say, hiya, can you please give us the best valuation, or a couple of different options if that's what the client wants to do as well. So yeah, there's no set bricks and mortar investment valuations, nothing like that at all. It's just a bit sort of free, easy, whatever's going to be the best one for them. Our ACR stress has recently been reduced as well. We used to actually stress at 150, so that makes it a little bit easier for some of these guys to get some of their deals across the line as well at the moment, especially in these current times, because I appreciate ICR is absolutely everything right now. So. The MUBs. So from our side of things, we can do multi-unit freehold blocks and leasehold blocks. So we can look at both circumstances there as well. We don't have any upper restrictions at all on limit on number of units. There's no limit there. So, we have got 3 or 4 of our units that we had in the books before, which have been in the sort of the 20, 30, 40 upwards sort of units there. So again, for those kind of situations, we'd probably need to have a client that's very experienced, got a little bit about them, been in the business for a little while, know what they're doing, et cetera, as well. So you've got yourself a first-time landlord coming in there. We wouldn't be able to do that. And also, if they've only got sort of the one buy-to-let they've had for maybe 6 months, for instance, we wouldn't be looking to lend to them on a 50-unit multi-unit, is the honest answer. So, it comes down to the right client being for the right deal. And again, just run that past us at any time if you need to for those situations. But we're very, very strong on the multi-units based on the fact there's no upper limits on the number of units that we can do there. Also, what we can do as well is if you've got a few of those units that come in at sub 30 square meters, which I know it seems to be a sort of a pretty standard line across the market at the moment, we can actually look at those and assess them as individual units as part of the block as well. So that's fine. So in that situation, of course, if you've got 10 units, 5 of them are 25 square meters or lower, and then you've got 5 of them above 30 square meters, we can average it out and take that on, no problem at all. Again, specialist valuations, same scenario. We use the VAS panel for those guys as well. Make sure that we get someone out there who knows what they're doing and what they're looking at. And we do consider lending up to 75% again as well. So that's no problem at all. Again, as long as they're in a position where they've had previous buy-to-lets running in the background as well. So, okay. I'll just touch a little bit upon our credit criteria. Although we are a specialist lender, and I appreciate some of those specialist lenders out there have got some sort of pretty easygoing credit facilities available for the clients in case they've come across something, where they've had some problems, etc. in the past. From our side of things, minimum loan size, maximum loan sizes would go to 100,000 and 2 million, but they are in a position where they cannot have any secured arrears at all in the last 12 months. No more than one in the missed payment in the last 24 months as well in that situation. And obviously the credit history must be up to date at the time of the application. So when it comes to us, we're in a scenario there, we'll ask them to sort of clear off any outstanding balances. They might have CCJs or defaults, etc. there as well. As you mentioned in that there, CCJs, we do obviously in a position where we can support them if they've had none in the last 12 months, but one in the last 24 months. And that is a maximum of £5,000. So we can't go any higher than that in any situation, I'm afraid to say. And from our side of things, again, that's exactly the same default CCJs. And any unsecured arrears after that or before that, we would have to refer it to the underwriter as well. So, if you've got anybody, I'm afraid to say, there's been any sort of IVA sort of situations there at all, or any sort of debt management plans and they're still in place and still running, I'm afraid to say that would be a no-go on those situations. So, there it is. Complex borrowing entities. So, who do we lend to as well? So, another key point here. Personal individuals, they do get stressed a little bit differently depending on their personal UK tax rate that they're paying in the UK. So obviously from that side of things, if you've got an expat who's living abroad, working abroad, of course, as per normal, and in a situation where they're maybe only declaring their rental income on a couple of properties in the UK, so it's 20, 30k per annum, for instance, we'd still treat those as lower UK rate taxpayers. Whereas obviously if they're foreign nationals but are living in the UK half the time and obviously paying significant tax in the UK, we'd have to treat them as higher rate taxpayers, and therefore 145 would be the stress on those guys rather than the 125, which we try and use for the majority. Foreign nationals and expats, obviously we can support those guys and girls. Foreign nationals, we do have a strict adhered list too, which can be found on our website, which has all been updated recently. But obviously, from our side of things, some of the quirky countries that we can look at, of course, or the countries that some of the other lenders don't like necessarily, North America and Canada, Australia is one as well that we can lend to. There's no problems there. India, and obviously South Africa, and pretty much the entirety to Europe. So from those side of things, there's a few other sort of countries in there which could be helpful, and expats as well. We don't have any technical limits as to where the expat is living. So you might have a UK national who's living on an island in the middle of nowhere. As long as we can sort of get comfortable with their source of funds and where the money's come from the case, etc., and they're working for reputable companies, that sort of stuff, then absolutely fine. We can support those guys and girls as well. Portfolio landlords. We don't have any upper limits on portfolio landlords. So again, from that side of things, we love to talk to those guys quite frequently. There's no way that we have any concerns. If anything, actually for us, we like the fact that they've got more experience and they've got a bit more about them in the background as well, in case anything was to happen. So they're normally well weighted and looked after. Limited companies, up to 6 directors. We can deal with SPVs, LLPs, trusts, and also offshore entities, which I also need to update because we've recently taken Gibraltar out of that list, I'm afraid to say. So, but Jersey, Guernsey, and the Isle of Man is still absolutely fine. So yeah, from that side of things, what I'll do, get that removed again before we send out the slides to you guys. But yeah, it allows us to have LLPs or limited companies that have been set up just offshore there as well. I'm afraid we don't deal with BVIs, so that would be a no-go for us on that situation. But I do appreciate that LLPs and trusts, and also trading companies as well, which isn't mentioned on there. We can use those kind of setup entities as well, which I know that's not always that easy to do across the market. So yeah, feel free to give us a shout on those ones. That's pretty much it. I would normally go a little bit more into obviously what the products that we've got necessarily, but as I said, right now we're in that kind of turmoil situation where we're trying to work out what we're going to come out with in the next few days. So I will follow up with Tony as soon as we have a product guide to send out to you guys, and of course it'll be hopefully released to you later this week or early next week at any time. But
we will get something out once again. We did think about this long and hard because we always issue these, but at the moment, we've had one lender that's actually made 2 changes in the same day recently, which I thought was a little bit excessive. But
as I said, Tony, I appreciate where you're coming from. You know, I used to be a broker. I hated that. You know, you just get yourself a deal, you've looked after the client, you've gone through all the information, you found the right deal in the market for that person, and then suddenly the lender goes, nope, it's not there anymore. And it may have only been within 24 hours as well. So it's happening frequently. And obviously understanding a little bit more now in this role as to what and why, but it is so volatile out there some days.
Crazily so. And we understand what lenders have to do, but as I said at the start, it just would be nice, I think, if lenders, rather than giving us 15 minutes notice of a product would actually give us, and we realise they don't want to be left sort of like as the lender of choice for a couple of days. I'm not talking a couple of days, I'm just talking maybe some time we can actually say to the client, right, we got you approved, can we get that booking fee off you, please? Can we get get the valuation, like, can we get your credit cards to pay for the valuation? You can't do that in 15 minutes. You really can't.
No, absolutely. And that's that's one of the lucky things for us, is that we don't charge anything. We don't have any application fees or anything at all. So you can get it in, get it done. Nowadays also we allow brokers to sign on behalf of clients as well, which means they can literally just get it pop done on the system. You key it, it's there. And we are in a situation where we've had to release a few updates and notices afterwards to say that if you don't get it in by a certain date, but we're normally giving 3 to 4 weeks notice to get guys to offer, which is within our time scales. So as long as we've got a client that's willing to help us as much as we can help them in those situations, of course we do try. But yeah, I feel your frustration. I'm certainly not saying it's not easy for anybody. So I'm with you entirely as well there. So
great. It's not, believe me, Lendco are not one of the lenders I'm referring to. The lenders I'm referring to, I'm not going to name the lenders I'm referring to.
No, please don't.
They're not present at any of our shows certainly in the next couple of months, because I'll probably lose my rag with them. But I do understand that's why we sent out that thing to everyone this morning, which was how lenders price their products and why products haven't been withdrawn at very short notice.
Yes.
When you've even got the trade bodies saying to some lenders, hang on a minute, this is...
Yes,
this really isn't right. But anyway, we'll get into the questions.
Of course, yes, please.
Thank you for that. First of all, I will just say we've been with Lendco. I think we was broker number 4 when they launched. One of the main reasons for that was that Graham listed all these senior people. Well, the person he put right at the top, Simon Knight, I've known for Christ, I don't know how long, and we've got an excellent relationship. Really an excellent relationship. He's my go-to person if I have a problem, and that's when it always comes to it's not what you know, it's who you know type situation, because and that is incredibly useful for us. I mean, I'm not on the phone to him every 5 minutes saying, Simon, can you do this dodgy deal with a 30 grand CCJ? It's not that type of situation, but I speak to him when I need his help or his guidance, and because we've got that relationship, and that, as all of you that are watching today will know, that is incredibly important when you're trying to get cases through that are borderline or are a bit sticky or are unusual.
Exactly.
It's just worth its weight in gold sometimes. The right questions from the audience is, what is your minimum property value?
So we don't have a minimum property value. Minimum loan size is 100,000. So it's around the 133k mark, I guess, is probably thereabouts. But if you've got a deal that's 99,000 or something, then just give us a shout. Again, we don't want to be doing something for 50, 60,000 pounds, but just under, please feel free to give us a call.
Okay. Do you lend to trusts for religious bodies? Need to put my teeth in.
I don't see why not. Absolutely. I'd certainly take that one to the guys and have a look at it, make sure there's no issues there from that side of things. But I believe a trust would be a trust in those situations. So
Steve, you know where we are if that's one that they can do. So
good.
And Martin has asked, for HMO, do you lend on these where the tenant is a charity that houses ex-offenders? No staff stay overnight.
No, unfortunately not. No. So with regards to that side of things, we can't lend to a charity entity, I'm afraid to say. So that would be the reason why on that one. But yeah, so the ex-offender side of things, we'd have to take a little bit more of a look into how the scheme would be running. So if it wasn't via a charity, it could be a possibility, but no on the charity side, I'm afraid.
Yeah, Martin, we might have a home for that. So maybe give us a call after the show's finished today. So Selwyn has asked, apartment, to make sure I'm not missing any questions, these are coming up thick and fast. Client has a 6-apartment block MUFB, needs to exit from development finance to remortgage buy to let. Can this be done in 2 weeks?
Pushing it is the honest answer. Yeah, absolutely. The reason for that is not necessarily our underwriting process, but it's just we've got to do manual valuations of everything. We don't do AVMs. So in that situation, of course, we've got to get a valuer booked in, sent out, report back again. That sort of timescale makes it very, very tough. So probably not. If it can be extended with a current provider, maybe for a little bit, for another couple of weeks, then yeah, 4 or 5 weeks. I don't see why we shouldn't be able to push that through.
Selwyn, could be a case. Let us know who the development finance is with, and if it's someone we know. Because again, we can maybe contact someone we know and say, can you just extend for 2 weeks? And rather than, there's some lenders that aren't going to do that at
absolutely,
all.
Absolutely.
Because of the way they're set up. They're not set up to be helpful to clients in any way whatsoever. Just try and screw as much money out of them as possible, which is probably why that side of the business will all be regulated at some stage, because the FCA will catch on and think, hang on, customers are being treated unfairly. Okay, so when I don't quite understand you said crowdfunding, if that relates to the development fund, I need to know who the lender is, because there's quite a few crowdfunding lenders. The crowdfunding, yes. Let's give us a call afterwards. Let us know who the lender is. It's something maybe we can look at. One quick question I'm going to ask you, you've got a couple of minutes. Are you appearing on any of the sourcing systems yet?
So we are any minute away from 27 Tech is the honest answer. We have actually held off of that just purely because of the fact that 1 minute we're in, 1 minute we're out at the moment. It's been such a volatile market. So yeah, we've kind of just decided to just wait till things stable out a little bit more, and then we'll go on to the 27 Tech system. So yeah, that'd be one big ones. We're with the LNG club, so actually we are part of the Smarter Fit that they've got set up over there as well. So yeah, and Knowledge Bank, we come up on Knowledge Bank as well if you've got any queries and questions via that. So yeah, we're up and running on those, but relatively recently for all of those, to be fair.
Okay, well, everyone, as those of you who watched our shows before will know, we developed our own sourcing systems for across the entire range of what we do, other than development finance. But on our commercial and buy-to-let quote, which is called commercial quote, on that system, Lendco has been on there since day one. So we can give you Lendco quotes literally within 90 seconds, quite easily. So with fairly limited information, we can give you an idea of whether that's doable or not. So you know where we are, and I'll give all the details at the end of today's show. I'm going to ask a couple of questions. I'll probably ask a couple of these. What is the maximum number of properties allowed for portfolio landlords?
Yeah, so there isn't any for us, which is lovely. We're in a position there where we can support those guys and girls, doesn't matter how many loans they've got elsewhere, etc., as well. We'll have a look at the background portfolio to make it sure it stresses up sensibly, but yeah, no actual limit of how many loans they've got. So
okay, and is consumer buy-to-let allowed?
It is, yes, yeah. So we do see quite frequently, especially with our expat clients, it used to be the old residential home they were living in here before they moved away. And there's certain circumstances where they're turning that into a buy-to-let, for instance, is absolutely fine. We can do that. We've had a few clients who are actually living in properties up to the day of completion almost as well. So that's fine as long as we've got a forwarding address and we can prove that they've actually started to move their details across into that address as well. So.
Okay, we'll just add that consumer buy-to-let was by far the stupidest bit of legislation that came out with the FCA, or probably even the FSA. I can't remember when it came out now, but the stupidest
FSA, I think,
came out. 2 paragraphs in their handbook. So every lender interprets it completely differently.
Absolutely.
We've still got a little bit of time. Do you have any appetite for standard buy-to-lets, but with 2 kitchens in the property?
Yeah, actually, that's a pretty good example. One of our slightly more unusual properties that we'll start to see. Yeah. So, for instance, you might just have a standard home with 2 kitchens, and a lot of lenders will look at that and say, "Oh, it's something, it's a HMO or a multi-unit or something silly." They put it under different sort of categories or don't like it. So, yeah, we're absolutely fine with that. No problems at all. That's probably a very good example of what we can do. Annexes as well on the sides of houses, that sort of stuff as well. So again, we can sort of treat that either as one, or if they're on 2 separate titles, as like a small multi-unit effectively. So yeah, there's no problems at all with the slightly quirkier setups in units.
Okay. Someone is typing, but I'm probably going to end. Oh no, it's current. Martin just said, very last question. Do you allow buy-to-let remortgage currently unencumbered for debt consolidation? They've refurbed it using credit cards.
Yeah, can do. Yeah, I'll be honest with you, we probably want to sort of see a little bit of a history about the client, make sure they're not obviously in any sort of financial difficulty, make sure we're treating them in the right way. But no, absolutely, we've done that. Some clients do think for some reason it's the best thing to do is put their house extension on credit cards. Don't know why, but we have seen it a few times. And if the value goes out and says yes, confirm it's all relatively new, then why not? Absolutely. So
it's called 0% interest, Graham.
Well, true. Yes, yeah, for 12 months, and then poof. So
yeah, that's quite simply the reason why. I think it's probably the cheapest way of doing it at the moment. Well, it is the cheapest way of doing it. So.
Yeah, I used to work for Lloyds Bank, funny enough, and used to see people just bounce their credit cards around and around and around in big circles every few years. So yeah, I do understand that side of it. But
Graham, thank you very much indeed. That's all your questions. That's all the questions from the delegates. Thank you very much. We're exactly on 10:45, which is great. So we're sticking to time. Simon will remove you from the room. Don't try and take yourself out because you might close the whole thing down.
No, thanks. Appreciate it, Tony. I'll see you quietly.
Thank you very much, Graham.
Thanks again.
As always. Thank you.
Cheers,
Simon, if you can put on the next speaker, next slides, that would be great. So our next is a lender who will be covering a little bit on buy-to-let, but also I think the majority of it is going to be commercial, but it's a very different type of product to what Graham has just been talking about. And here he is. Mark, can you hear us? Mark? Hello, Mark.
Hello there.
Can you hear us? Can you hear us?
Yep.
Yeah, good. Okay, fine. Okay, your slides are up. So I'll crack on with the introduction. Oh, he's gone. He's come back again. There he is. So all good? Still hear us?
Can still hear you, yes.
Oh, but actually that's better. We can hear you a little bit clearer now as well. So, okay, so next speaker. Mark Dobson from Redwood Bank, who we've known for quite a while because of where he was previously, which I'll show you in a moment. And I think Redwood is one of the lenders we've actually sent some information out on today. So you've got this plus also one other document coming up as well. Well, actually, no, we haven't got the other document coming up, which is regarding their residential investment. But they are a different type of lender to what we've just heard. So a little bit on Mark. Mark has a wealth of banking experience, having worked in industry for 21 years. He started out working for Lehman Brothers, where he was appointed senior analyst. Before moving to Redwood, Mark worked for NatWest for 13 years. That's where we know him, where his roles included broker business development manager, relationship manager, and development manager, and which involved overseeing Essex, Hertfordshire, and London. During his career, Mark has gained valuable experience working with customers from a wide range of sectors. He has shown commitment and dependability, providing them with a huge variety of products, including term loans for trade and business, property finance, asset finance, and unsecured loans. Claim to fame, I told you it's a bit diverse. So we've had the Chuckle brothers. Here we are. Mark recently met Princess Anne. From the Chuckle brothers to the royal family. So there you go. Circumstances, Mark, what was the... Was you being sort of like given an OBE or something, or was it 90?
No. I mean, after that first slide there, I think I deserve an OBE. But no, I went to a charity event actually where there was a link to the armed forces, and Princess Anne was the kind of honorary guest there that evening, and I just happened to be at the door as she come in, So I was the first one to meet with her, and practice my bow. Not my curtsy, and and had a good chat. Actually, she spent a lot of time talking to me, which I thought was nice of her. So yeah, a bit of an unusual random evening actually.
Certainly was. I've never met any of the royal family, so they probably want to meet me either, I should imagine. So right, I'll leave you to it. I know yours is a bit different because of the way the market is. So this isn't so much a presentation. It's what you've received today, but Mark's going to go through it in much finer detail. So I'll see you 20 minutes, Mark. Good luck.
Great. Thank you. Thanks very much. And thanks for the introduction, Tony. First of all, appreciate I haven't actually got a presentation here. And the reason for that is that the bank have had so many changes recently to policy, debt servicing cover, loan to values. In fact, we've changed so much that we couldn't actually get a presentation which was compliant together in time. So for the time being, we're just using these the flyers that we've got that we send out to our broker market for commercial. There is one for residential as well that hopefully that you've received. I don't think it's on your pack here today, but we'll share those afterwards, and I'll talk around that today anyway. But unfortunately, just for the time being, you've got my face to look at and just our commercial flyer. So we're kind of making do at the moment. Yeah, we've got residential as well. Brilliant. Okay, well let's leave it on the commercial one for now, and we will we'll chat through that one first. So, just a very brief introduction. We've already done a bit about me, which is great. Thank you. So just with Redwood, Redwood's been trading now a new bank 5 years ago, coming up to our 6th year of trading, making a good amount of profit for the past few years. So very sort of sound and sustainable bank, set up primarily to focus on investors, really. So we're looking for residential and commercial investment landlords, looking to support them with loans up to a volume of 8.25 million, and our minimum loan size 125 grand. So that's the kind of market very broadly that we operate in: purely commercial investment, term lending, and commercial owner-occupied mortgages we do as well. We are sort of looking in the sort of near future to venture into new areas such as bridging and perhaps invoice financing as well. But for now, it's a very unique suite of products, which I'll chat through today. We've got offices in Hertfordshire and in Warrington. So out there are two sort of head offices, basically around 110, 120 staff, I think, sort of growing very, very gradually. Yeah, there's about sort of 7 or 8 BDMs across the country. We take deposits in from our savers, and ultimately we lend that money out. So good old traditional banking. Underwriting is manual. We don't really have a portal, although we're sort of toying with one that we've got in testing stages at the moment. We've got a team of underwriters. As a BDM team, we write the applications up, and they're manually underwritten. So yeah, so that's the process of how we look at applications at the moment. So I'll start off by just talking through the commercial flyer that we've got in front of us, to give you a steer on what we can do there. I've mentioned the fact that it's sort of the loan sizes that we're looking at. I'd say, just to give you a really broad steer, our average loan that we do is around about 700,000 to 800,000. So we do a combination of sort of, probably quite a lot at 1.5 to 2 million, but we do a lot at sort of sub 500,000 as well. And we've really seen recently the market has dictated that sort of a lot of the smaller loans are coming to us, because I think as a reaction to other lenders perhaps changing their stance or their appetite around the amounts that they can lend. So with commercial investment mortgages, I'll focus on some of the key sort of factors for that product. We like to see commercial lending on a capital and interest basis. We can introduce some interest only, but we do like to see at day one that the loan's amortising. So what I mean by that is we'd do a term of 25 years as a maximum. And if a customer, for example, wants a 2-year interest only, we'd just like to see on day one the fact that that loan can amortise over the remaining 23 years. So although we put there that we do look at capital and interest, we do like to see, we can introduce some interest only, but we do like to see it amortising. With commercial, we've got 2, 3 and 5 year fixed. The 2 and 3 year fixed rate starts at 8.5 currently, and the 5 year starts at 8.75. The way we approach pricing is on a risk-based approach. So we do offer bespoke pricing, and some of the things that affect that pricing, the margin that the customer gets, are the loan to value, the debt service cover, experience, asset quality, location, and those kind of things. But generally speaking, that's where our fixed rate products start from. The 5 year fixed rate, although a little bit higher on commercial, does offer a lesser stress test. With most lenders, that's the case. There's a 2% arrangement fee, and we pay 1% away to you as the broker. And then I guess some of the sort of assets that we're looking at on an investment basis are very broad, really. So we do lots of things like warehouses, industrial units, shops, pubs. We've done some B&Bs, guest houses and hotels as well, on an investment basis. With any investment loan, we only really lend to experienced landlords. sort of put, although we don't have a sort of hard and fast rule for being experienced, we generally like to see in the commercial world the fact that the applicants had two properties for more than 2 years, and that just really gives us a good indication that they've had the opportunity to set up a lease, deal with inquiries, perhaps deal with a break clause or complaints and tax and all the sort of joys that come along with being a commercial landlord. So in terms of investment, really that sort of covers the sort of, generally speaking, the type of situation that we'll look at. When we assess the debt service cover, we take the annual rent, we deduct 10% off of that to allow for dilapidations, any costs, any sort of anything that the customer or the landlord wouldn't be expecting. And then we look for 130 or 1.3 times cover on the pay rate. So that's just to give you a general idea of sort of how we calculate the debt servicing cover. So also coming under the sort of commercial bracket for our type of lending is commercial owner occupier. So these will cover the situations where you've got a customer who has been operating their business, perhaps they've been paying rent, or they want to move into a commercial premises and they want to set up a commercial mortgage, basically, simple as that. Same sort of debt servicing cover applies to that. So 130% cover we look for, up to 70% loan to value. Fixed rates are the same as what they would be on a commercial investment, because the asset is risk weighted the same, up to 25 years term. And we can introduce some interest only if the debt service cover is proven on day one. So for owner occupied mortgages, we 130% cover if the loan to value is up to 65%, and 145% cover if it's 145% cover for the loan to value if it's over 65, up to 70%. We base for owner occupied commercial mortgages, we base the debt servicing cover on 3 years worth of EBITDA. So the business would need to have been trading for 3 years. So we like to see 3 years sustained profits, minus any adjustments for things like drawings or other debt commitments. And the profit that's been left in the business on an average basis will determine what we can lend. Now, the key thing with the commercial mortgages at the moment is obviously the COVID impact, which is sort of thrown a right spanner in the works with how we sort of assess a case. So to bring it to life, really, I've funded recently an owner-occupied pub. Now that pub had been operating for a very long time. The partners that were running it have been in there for 12 or 13 years, I think. So they had 5 years or 6 years worth of accounts they could show us, really, really consistent, other than the main COVID year, where the sales were down as you'd expect because the business had been closed and the figures were really impacted by grants. But it's sort of about taking a pragmatic view, I think, in those situations. So we were able to see that actually the 2 years before COVID and the 2 years since COVID, the business had been really, really sort of regular in terms of their turnover, their costs and their profit. So we were able to take a view on that and kind of not ignore the COVID year, but sort of take that out of the sort of workings that we did, and really show that actually the commercial mortgage would save the customer money compared to what they were paying in rent. But on the same hand, I've had some situations where we've looked at trading businesses where they have really only been trading for, say, 3 or 4 years, and it's really, really hard for us to get a real good steer on what is a regular profit line for that business. Some businesses have had a massive boost since COVID, some haven't, and so we're only going to be comfortable with those that we can see where we can get a real good average from. 2% arrangement fee for commercial mortgages, and for anything commercial, we pay 1% over to you as the broker. With commercial, we do like to have the loans repaid by age 75 approximately. So we're okay if it goes to 66, 76, 77, if there's a sort of a residual amount left to pay at the end. So we do take that into account more with commercial, because we really like to see those loans amortising. And when I come on to the residential products, you'll see how that kind of changes. So I think, yeah, really that covers the commercial side of things. We'll move over to the residential products now. So hopefully you can see that on your screens. So a sort of similar kind of approach in terms of loan sizes, and with residential, that sort of, for us, that sort of captures anything that's a flat, a house, a multi-use block, a HMO, anything which encapsulates being a residential property is taken into this bucket of loans, basically. Again, we consider the age, but we're a little bit more flexible. Residential, I think there's a view that residential will be easier to sell on, perhaps in the future, refinance, that kind of thing, because most lenders have a bit more of a flexible approach to residential assets. Again, we offer a 2, 3, and 5 year fixed, and those fixed rates start from 6.74 across the board. So different to commercial, where we've got a slight differentiation in the 5 year. With the 2, 3, and 5 year at the moment, as of today, the fixed rates start from 6.74. Again, it's a bespoke pricing approach where we basically take a risk-based measure against the margin that we offer. So things like loan to value, debt servicing cover, age, loan to value, location, all those kind of things are taken into account. But generally speaking, we can bespoke the pricing towards that customer. So I guess there's a couple of different sort of debt servicing metrics that we've got, depending on what kind of HMO or what kind of property that we're looking at. But really, to keep it simple, for residential properties, for example, a standard residential buy-to-let or a standard HMO, like I guess a 3 or 4 bedroom house, which is being used as a HMO, we'll go up to 75% on loan to value. So that's 75% for capital and interest and 70% for interest only. The term of up to 30 years, and that's again for capital and interest or interest only. We can actually do 35-year term now if the properties are within the M25, because we recognise the sort of the yields there are a bit more challenging. 125% debt service cover is what we look for. If the loan to value is up to 70%. And again, there's a 2% arrangement fee, but 1.5 of that is paid to you as the broker for residential. And that's really a reflection of how the bank are trying to attract that business over the commercial. For HMOs, we do differentiate a HMO. So if you've got a larger type HMO, perhaps a 6, 7, 8 bedroom HMO, which has had alterations to it, perhaps it's had en suites put in, and it isn't really considered a standard house, we'll assess those slightly differently. But again, the same rates apply, and we can be quite competitive in terms of what we can offer in terms of leverage for HMOs. Very keen on anything residential and HMO. So that covers off the residential side of things. So we do sort of a lot of portfolio loans where customers come. So I've got 6, 7, 8 houses or perhaps more. Some of our USPs include lending to landlords that let their properties out to charities, housing associations. We've had things like Serco, vulnerable adults, and other charities as tenants. We're quite happy with that, but as long as we're using the market rate rent to prove our debt servicing cover. We'll consider expats. We'll consider customers who've got credit blips, perhaps have had a CCJ in the past, which wasn't their fault, as long as they can explain it and we can get comfortable that it's a responsible lend, then we can get our heads around that. We'll consider LLPs, SIPs, SASs and trusts. And we'll also lend on a single asset at the moment up to 6 million, although that's being reviewed at the moment. I think that single asset limit might come down. Multi-use blocks as well are included in that as well, so we do quite a lot of those. Just to give you an example, on a semi-commercial, because that sort of encompasses both of the commercial and the residential policy that I've spoken about, and this is where we've got a real sort of niche here, I feel anyway. Perhaps you could tell me otherwise, but for semi-commercial asset, we will use the policy which is dictated by the rental income. So what I mean by that is that, for example, if you've got hairdressers downstairs with 2 flats above, hairdressers creates 10,000 per annum rental income, and the flats create 30,000, then we'll use the residential policy for that. So in theory, what we can do is use our residential policy for a semi-commercial asset. So we could offer potentially for a semi-commercial 30-year term on a rate from 6.74 on the fixed. So it can be quite competitive, and we do a phenomenal amount of that type of loan. On the flip side, if the commercial income is higher than what it is for the residential element, then we will have to use our commercial product. So it works really well. A lot of the time where we have, for example, a shop or a retail unit with a HMO above it, we can be really competitive. In terms of process, it's manually underwritten. So you come to us with, you come to me with your inquiry, either a phone call or an email. We'll have a chat through, see if we can get to a point where the customer's comfortable moving forward. I'll give you a suite of information that we need. Once you provide that information, the application's manually underwritten, which is good because we can explain things like if there's credit blips, experience, something quirky about the asset, for example, we can explain all that in the application, through to approval when valuation quotes and legals, either single or dual rep services, are okay with us. And when the loan's approved, we try and draw things down within 6 to 8 weeks, if not sooner, really. As soon as that loan's drawn, we're very, very keen to get the loans into a position where they can complete. I think that covers everything off for me. Thanks, Tony. Should bring me to my 20 minutes.
We've got a couple of questions which I'll just run through. Neil Patel, hi Neil, said, do you lend to SIPs?
We do, yeah. We lend to SIPs, yeah. So we'll always suggest that the customer checks with their SIP provider just to make sure the loan is within the terms of their rules. But yeah, we do quite a lot of SIP lending.
Is there a minimum advance of any kind? A lot of lenders have a minimum because I don't like, because SIPs can be so bloody difficult.
Yeah, I mean, our minimum loan size is at the moment 125 grand. It's under review because of the volumes we've got at the moment, to be honest, Tony. So we do see a lot of the SIP loans do come in at a lower value because obviously it has to be half of the fund value. But at the moment, yeah, down to 125,000 we can go to on any loan.
Neil just popped in another question. Is there a minimum period of ownership for a remortgage?
There isn't, no. So a lot of the customers that we lend to have bought assets recently or had them transferred into their name, then we can refinance them immediately. We lend against the valuation, not the purchase price. So if a customer has bought something at a discount, we can lend against the valuation, not what they've paid for it. So sometimes that reduces their contribution.
Okay, Nick has asked a question. I'm just trying to figure out the last bit. So on an HMO, he has a client who has sold 2 properties. Would you lend if he has one? I'm just interpreting what Nick's trying to say here. Would you lend if he has 1 buy-to-let and 1 resi, and moved home? I don't understand the last bit. And moved home, will you lend to him? So client has got 1 buy-to-let, 1 resi, but has previously had 2 previous buy-to-lets. I think I'm getting from that.
Okay, yeah, this is all about being really comfortable that the customer is an experienced landlord. So again, we haven't really got a number on it, but if they're going to operate a HMO, we just want them to be comfortable that we can see that they are experienced. They do know how to set up an AST, deal with queries, tax, complaints, health and safety and that kind of thing. So I would normally say for a HMO, depending on the size of it, I'd like to see him having had 2 or 3 residential properties for a good couple of years, really, just to sort of show their experience.
There's no more questions from delegates. So I've actually popped in a question. I don't think you mentioned this, but on the HMOs, do you have a maximum number of rooms?
We don't, no. So no maximum. It will come down to, feasibility, demand, what we think the sort of exposure risk is, but no maximum in our policy.
Okay, and the other 2 questions you set yourself, you've already answered actually, because you mentioned both of them in your presentation. So,
okay,
and turnaround times, I know that's an ever moving situation.
It is, yeah. I mean,
how much business you're getting in more than anything else, isn't it? So
yeah, it does. It really does. And I think about 6 weeks ago, if you'd have sent me a complete application today, we probably would have got your credit response within 2 or 3 days. But since the end of last month, and I don't know why this is, but we have had a massive influx of applications, like a real. I've been here around 2.5 years now, and this is the busiest I've ever seen it at Redwood. So that is really impacting on our service levels. But I am saying probably at the moment, so I've got a completed info pack in today. We will get that application written up over the course of the next 24 hours, and I expect to have a credit approval within, say, 6 working days. But I imagine the next couple of weeks we'll bring that back down again to sort of 3 or 4 days.
Okay, brilliant, Mark. Thank you very, very much indeed. Good to see you again. And
you too. Thanks for having me.
Simon will remove you from the room. Again, I always say because one person did almost actually cut the whole thing off.
Yeah, I was warned about that.
Yeah, so don't touch any keys
or
the mouse just for a second. Someone will remove you from the room. I should have actually said when Redwood was speaking in the last one that once again you won't find them on any sourcing systems because of the type of lender they are, but they are on our sourcing system, our commercial quote system. So again, we can give quotes of exactly what they can do, and of course we want you to come through us to help you get the case through, whether we're giving the advice or you give the advice, because we've been using Redwood for a long time, so we do know their systems and how they work inside out. And we can give you those quotes literally straight away, and also compare it to what else is available in the market from all their main competitors who are also on our commercial quote system. So I'm waffling a little bit because I'm just hoping that our next speaker is now in the room. I'm hoping he is. I haven't seen him appear yet, but we'll just have to wait and see. So I'll talk very slowly until he appears. Otherwise, there's going to be a pregnant pause at the end of it. And I'm not going to be able to do his presentation, I can assure you. So we have Steve Mannakee from West One Loans, who's going to be talking about their regulated mortgage product. And you'll see here, it says product guide. West One was one of the lenders where we couldn't have a product guide because quite literally it's changing on a fairly regular basis. Again, West One are one of those lenders that do give us some notice when something changes and gives us actually time to do what we need to do for those clients that have already been quoted. So hence the reason why they're speaking today, because I have really got quite annoyed with some lenders and the way they've been acting and the way they've been working things. Like I said before, I do understand what's behind it sometimes, but just bad organisation. Just as I said before, meet at 9 o'clock in the morning, not at 2 o'clock in the afternoon if you're going to pull your products at 3 o'clock, and just give us a little bit of time to do our job. So he's still not there, which is not good. So this next bit, this is about Steve. He's worked within the mortgage and financial services industry for over 25 years. He started out as a mortgage advisor before moving to area sales manager, where he supervised a team of mortgage advisors within both lender-owned and independent corporate estate agency financial services. Steve spent several years working in wealth management, corporate offshore financial planning with HSBC private clients, and has spent the past 15 years in a broker-facing business development role, predominantly in the specialist mortgages arena. And I'm just going to check if he's actually even as a delegate at the moment. So he's not. All right, I think my team are trying to track him down at the moment and see where he is. So anyway, onto his, I have to talk really slowly now, onto his claim to fame. We've already had the Chuckle Brothers. We've had Princess Anne. Our last two are an internationally famous film star, one of the most famous film stars in the world, and one of the most dangerous men in Britain. Okay, and something else I'll just add as well, just whilst I'm waffling, just whilst we're trying to get Steve, find out where Steve is. Our final speaker, which is Tuscan Capital, we're going to be talking about bridging, have kindly offered a £100 gift voucher to a delegate, which will be done as a prize draw. And we've been working out how to do this because as you can imagine, it's quite difficult. It's not as if I'm putting my hand in a fishbowl and pulling out a name because everything's virtual. So what we would do, as when he's about 3-4 minutes from when he's finished his presentation, my team are going to take all the list of all the delegates who are logged on at that time and bring it into me. Each one will be given a number, and then I'm going to ask the speaker, there's Steve, I'm going to ask the speaker for a number, and he'll give me a random number, and that will coincide with whoever wins it. But you have to be on, you have to actually confirm that you're online to receive it. So if you don't confirm within 10 seconds, then we'll ask for another number. Anyway, Steve, you probably didn't hear any of that. Steve can hear us. You're there.
I can hear you fine. Morning, everybody. How are we all?
I'm just about to come on to your claim to fame. So I've been waffling a bit just whilst I was just coming to that. So, okay, claim to fame. Steve was once killed 3 times in one day by Mel Gibson.
It's the best I can think of. Tony. To be fair,
it's better than some I've heard, so it's not bad. Okay, can you explain? Can you explain?
yeah. My younger brother Paul, his childhood best friend is a guy called Tony Smart, and his family are part of the Smart Circus family, and him and his dad do they do all the stunt mastery and horse mastery on various films, and they did it for Braveheart. And when I was on a week's holiday, myself and my brother were quite keen amateur boxers when we were younger, so we're quite used to falling over. And we were asked, would you like to come to Ireland for a week and just do some play fighting and get paid for it? And the answer was obviously yes. So I spent a week as an extra on Braveheart, and yeah, it was probably more than 3 times in a day. I lost count, but I'll stuck with 3 times. But yeah, Mel Gibson ran a toy sword through me 3 times in one day. Quite interesting. He's an interesting guy, Mel Gibson.
I'm sure he is. Just never get in a car with him. That's probably all I'd say.
Yeah, you're probably right.
Right, everyone. Right, Steve. I will put you onto your first slide. I'll see you in about 20 minutes. Good luck.
No worries. Good morning, everybody. Apart from my history of being killed by film stars, my name's Steve Mannakee. I'm National Account Manager at West One. I've been here for 7 weeks now. This is my 7th week. It feels like longer, but in a good way, obviously. So what I've been asked to do is spend a little bit of time with you this morning talking about all things West One. What I'll do is give you a little introduction to West One and the wider ENRA group so that you know who it is that you and your customers are dealing with. And then I'll give you some highlights around what I've kind of identified as what can be described as our kind of 3 main pillars of lending. The things that I feel that we sit quite proudly as specialising in within the specialist space. And then any questions that we've got, please feel free to fire them at me at the end. So who are West One? Well, we're part of the wider ENRA Specialist Finance Group, which has been around for over 20 years now. We're one of the biggest and fastest growing non-bank lenders in the UK. And we launched West One in 2005 as a lending entity, ostensibly and originally as a short-term lender, so bridging finance, development finance. And in the years in between, we've launched into the seconds market. Specialist buy-to-let was launched sort of 4 years ago. And the part of the business that I sit within is the very recently launched first charge resi side of the business. In Q3 last year, we were bought by the Elliott's Investments Group in America. And I spent 5 years with Pepper Money prior to joining West One, and I was with Aldermore for almost 10 years prior to that. So I've been around the specialist market for 15 years. So it's very similar to shortly when I joined Pepper Money, they were bought by KKR Investments in America as well. So we're now part of the wider investments, Elliott's Investment Group, which gives a really good, strong financial underpinning and backing to us because they have 50 years worth of investing worldwide under their belt. They own and manage the largest activist hedge fund in the world. And for the football fans out there, they own AC Milan. And they were one of the bidders for Man United earlier this year. And as a Spurs supporter myself, that was monumentally insignificant to me, that fact. But it's not until you join an organisation that you realise kind of how wide and you know the group that you're working for actually is. So that's just a little bit of a potted history around the ENRA Specialist Finance Group and West One. One of the main benefits of now being part of Elliott's is that we've got access to retail funding lines, which means you're doubtless on the resi side and on the specialist buy-to-let side seeing us source much more attractively now, which is brilliant. So what do we do? I talked about those kind of 3 pillars of lending. The first pillar is the lending that we do that's inextricably linked to the fact that we don't credit score. So we are one of the near prime group of specialist lenders that are sat just below the godlike lenders, as I like to call them. So the Santanders, the Halifaxes, the Nationwides and the NatWests of this world. we are in that near prime specialist space. So we trade punches with lenders like Pepper Money, Aldermore, TML, Kent Reliance, Kensington, Vida, those sort of lenders. And when you're part of that near prime specialist group of lenders, I think you each have a main specialism, the thing that brokers associate with you most quickly. And our main specialism is that we don't credit score. So we are one of the very few true non-credit scoring lenders out there. So there's no scorecard and no algorithm involved. We use Equifax only, so we don't overlay what we find onto TransUnion and Experian as if we're trying to look for trouble. We use Equifax only. It's a soft footprint at dip stage, and it's the conduct on the Equifax data that will determine whether we can lend to your customer and which of our 4 product tiers your customer sits within. So we specialize in lending to where people fail credit score, I guess. And it's the natural assumption that we must be an adverse lender, because why else wouldn't you credit score? It must be to help people that fail credit score, and people fail credit score because of adverse. Our definition of adverse is probably the same as your definition of adverse, which is CCJs, defaults, and mortgage arrears. But it's really, really important that you remember, if you don't remember anything else about this first pillar of lending that we have, is that the reason we don't credit score goes much broader and deeper than just being able to help people that have CCJs, defaults, and mortgage arrears that are causing them to fail credit score. Because people fail credit score for lots of different reasons, right? You guys are the experts, you know that. You can have, at one end of the polar scale, you can have first-time buyers who are failing credit score because of a sheer lack of credit activity. We can lend to those customers and save some of those deals for you, because in many ways we don't treat first-time buyers any differently to somebody on their second mortgage. And unlike some of the other specialist lenders around us that do also lend to first-time buyers, what we don't need is for them to be privately renting. And by doing so, it gives us the confidence and the comfort of knowing they've had that mortgage-like commitment coming out the bank every month for the last couple of years. We can lend to first-time buyers that are still living at home with parents. It's about their conduct on Equifax and whether it works on affordability. At the polar opposite end of the scale, you've got customers that are failing credit score for the polar opposite reason. Those people have got loads of credit. They've got a very prominent footprint on Equifax. Their credit is impeccably maintained. They're failing credit score because it's been decided they've got too much debt in relation to their income, and they're failing those dreaded debt to income ratios that are factored into the scorecard in the background with credit scoring lenders. As a non-credit scoring lender, we don't have a scorecard to factor a notional maximum debt to income ratio into. So we can save, loads of your debt to income ratio driven credit score declines as well, because for us, it's just all about affordability. If the loan amount you want in tandem with the credit you've got in the background, or if you want to consolidate it, if it works on our affordability model, we will lend, irrespective of similarities that might exist between debt and income levels that might frighten a credit scoring lender to death. So we can save a lot of your debt to income ratio driven credit score declines as well. So those are the two polar opposite ends of the spectrum. And in the middle of those two extremes, you've got customers with a different problem again. These people have got the right amount of credit, so debt to income ratio is not a problem. The reason they're failing credit score is because they've got a bit of a rubbish history of paying their unsecured revolving and fixed term credit back on time. And their credit profile looks a little bit like a Dulux colour chart. It's got yellows and greens and reds and oranges dotted about all over it. And we can give you as much flexibility, if not more, compared to most of the lenders around us in relation to somebody that's got a bit of a hit and miss history of paying their unsecured credit back on time. And of course, when your poor payment conduct on your unsecured credit does get worse, you move on to the next evolutionary step and you fall into what is traditionally known as an adverse customer situation, and you're defaulting on stuff, picking up CCJs, getting mortgage arrears. We can lend to you there too. So what I'd ask for you to do is just to remember that our non-credit scoring specialism doesn't just mean that we're here to help you with your cases that fail credit score because of CCJs, defaults, and mortgage arrears. The reason we don't credit score is because it gives us the ability to lend to customers that are failing credit score because of any credit profile related reason at all, including CCJs, defaults, and mortgage arrears, as opposed to exclusively because of CCJs, defaults, and mortgage arrears. Hopefully that makes sense. We've got an individual manual approach to underwriting. We offer true dedicated case management, and you can talk to your case manager right through the process and journey from submission to offer. And just as a little bit of context around how flexible we are around credit profile related issues, we on 3 out of our 4 product tiers, we will completely ignore CCJs and defaults that are satisfied. Doesn't matter how many you've got, what the pound's value is, or when they were registered. If they're satisfied, we ignore them. For CCJs and defaults, singularly no more than 500 quid, we'll ignore them on 3 out of 4 of our product tiers. So again, doesn't matter how many you got or when they were registered. If none of them are for any more than 500 quid, we ignore them. We accept CCJs and defaults that are unsatisfied over 500 quid. We don't really kind of set any limits, and it's the registration date of the most recent one that will determine which of our product tiers you sit within. And fairly unusually, we on, again, 3 out of 4 of our product tiers will completely ignore utility and comms accounts, whether we're talking just poor payment conduct or defaulted stuff. We'll ignore them because we know they're the most pain in the backside ones that can come out to bite you on the backside when you're least expecting it. So we just ignore them. There's nothing worse than getting a credit file through, having a look at it, thinking it fits a particular tier with a particular lender. You do the dip, and then you find a utility default from an undisclosed address, or a niggly 40 quid default on a mobile phone from 4 months ago that's not on the credit file, that either brings you down the tiers from a better one to a worse one, or stops you lending at all. So we know that can be the case sometimes. So we just ignore them. We just ignore them. Mortgage arrears, we're pretty good. We'll accept them on all of our product tiers. On the top product tier, they've got to be 2 years old. On our middle 2 product tiers, Prime Plus and Prime, they've got to be 12 months old. And on our bottom tier, near Prime, you can have one in the last 12 months, but none in the last 3. But one thing we're really good at are those late but not missed mortgage payment scenarios. You've probably had situations where you've got a credit file thinking it's all fine, and then you find that annoying status 1 on the mortgage account in the last 12 months, which will prevent lending with most lenders. For us, but the customer tells you they didn't actually miss it, it was just late. Now, most lenders will determine that as mortgage arrears, because if you don't pay your mortgage payment on the designated day of the month by midnight, that lender will register a status 1 on your mortgage account. Our definition of mortgage arrears is when the payment's not been made by the due date of the following month. So if you can show us that you've, via bank statements or whatever, if you can evidence that you just paid that mortgage payment late and you didn't miss it, that status 1 doesn't exist as far as we're concerned, because we don't class that as arrears. So that can be the difference between you sitting in the top product tier and maybe not with another lender, but with ourselves, you'll still qualify for the product tier you thought you qualified for, because that's not mortgage arrears as far as we're concerned. So if you've got any of those classic late but not missed mortgage payment scenarios, chat to us, because there's potentially a way of doing it. We'll give you loads of flexibility around missed and late payments on unsecured credit where the account has no more than a 500 quid balance on it. And if you've got unsecured credit accounts where there's missed payments and the balance is more than 500 quid, we can still help you. We're one of the very, very few lenders that can lend to you on standard products where the customer's currently in an IVA or a DMP. And for those customers that are out of an IVA or a DMP, we need you to be out of it for 2 years to qualify for one of our better product tiers. Most lenders will be 3 years or more on that, and there might be some specific, fairly scarily priced product choices only available in situations like that. Our maximum loan singularly is $1 million, but we do have the ability to go up to 1.5 by referral. So that's kind of pillar 1. Anything credit profile related. Whether you're a first-time buyer with a lack of credit, somebody with loads of credit, perfectly well maintained, but failing debt-to-income ratios, or someone that's got the right amount of credit, but being late or missing payments on unsecured credit, or true adverse, we can help you. So that's the lending that we do on pillar 1 that's inextricably linked to the fact that we don't credit score. Pillar 2 would be all around affordability. As you'll know, the ability to go to 5 times or above is very much the remit of the high street lenders, because they want the squeaky clean lending. We specialist lenders that are there to help lend where the high street can't, either because of credit profile issues or a specialist need that the high street can't handle, like latest year's income for the self-employed. Our safety valve in being able to help in those situations is the fact that we're a bit less generous as far as LTIs or affordability is concerned. So you'll struggle to find any specialist lender out there that will do more than 4.5 times, but we can go to well in excess of 5 times. So we can kind of give you a bit of a win-win scenario. We can do what the high street can't around credit profile issues or other specialist needs, but we can also do what the high street does do in relation to affordability. Everything's automated. We work on household composition, ONS data, and the customer's net income situation. Unusually, we don't ask for full bank statements. We want 2 months worth of pay slips for the employed. We want bank statements to go alongside that, but we only need the bank statements to show salary credits. We don't need to see anything else, so you can filter it all out. So we're trying to put as few barriers in the way of lending as we can. We can go to 5 times income without any kind of special criteria applying on 3 out of 4 of our product tiers. And on the flex options that exist on Prime Plus and Prime, as long as you're satisfying the minimum 50 grand household income that we stipulate, we can go well in excess of 5 times multiple or LTI. There's no real limit set. It could be 6 times, could be 7 times. As long as you're satisfying that minimum income requirement and it works on our affordability model, we can do it, okay? Other ways we help affordability, we can take up to 100% of people's regular but non-guaranteeable additional income on top of basic salary. So overtime, commission, bonus, that kind of stuff. We need to evidence consistency to be able to do that. And the first way we do that is by saying the customer really needs to be in their current job for at least 12 months. And we look at an annualized average of the last 12 months. So whether you're in the sort of job that gets you 1 extra to your basic salary, so let's say a car salesman on basic plus commission, or whether you're in the sort of job that gets you several extras to your basic salary, so maybe a police officer gets 2 or 3 different types of overtime, 2 or 3 different allowances. We basically say that whether you get 1 extra to your basic or 6 extras to your basic, if they're showing on the last 2 months' pay slips consistently, we kind of assume they're always there. And the calculation that we'll do, which is the calculation you should do, is an annualized average of the last 2 months. And as long as the year-to-date figure on the latest pay slip and the last P60 generally tends to back up that total figure you're putting in, we'll end up taking all of it, which is brilliant, whereas most lenders around us are limited to 50%. We'll use latest year's income for the self-employed. So no limit on the increase on income on previous year. Could have gone from 50 grand to 200 grand. That bit's not important. What's important is the percentage increase. So if you've not gone up by more than 20%, we don't ask any questions. If it's an increase of more than 20%, we just need a rationale from you around how and why it's sustainable. And as long as that makes sense, we're good to go. If there's business-related credit for the self-employed that's in personal names, we will factor that out of affordability. So if you've got a self-employed plumber that's paying 400 quid a month on lease to a van, but we can get confirmation from the accountant that it's a business cost, we will factor that out of affordability, even though it's in personal name. We can factor adult children out of the household composition and therefore make them non-financially dependent. If they're earning and they can evidence 600 quid's worth of net income a month, for us that constitutes being financially independent, and they're out of the equation as far as household composition is concerned, which can help on affordability. And we can do terms of up to 40 years and up to age 85 at the end of the term on resi. We class normal retirement age, unless you tell us otherwise, as age 70. So unless you tell us differently, we'll assume your customer is going to retire at age 70. If your customer comes to us at least 10 years away from that or more, so age 59, as long as they can evidence that they're paying into a pension, whether it be private provision or via the employer, that's their repayment strategy sorted as far as we're concerned, and you can go up to age 85. Other income-related criteria, we want you to be in your current job for at least 3 months and out of probation. We don't set any overarching minimum employment period beyond that. You could have been out of work for 5 years. As long as you've been in your current job for 3 months, that's fine as far as we're concerned. If you've been in your current job for less than 3 months or you're in probation still, we can still lend to you. So as an example, if there's continuity of employment there, so you might have been working for Tesco's for 5 years, you've moved to Sainsbury's and you've been there a month and still in probation. What's the chances of you not passing your probation period? Pretty slim. So we'll still look to lend even though you're still in probation. We can take a standard up to 50% of a secondary job, as long as we're generally comfortable that the concept of you having 2 jobs moving forward is sustainable. And we can even go up to 100% of that second job as well. 100% of court ordered maintenance and your net position on background buy-to-let portfolio, and the income you get from it, we can take 100% of that as well. And we're pretty good on contractual income generally. So fixed term contracts, rolling renewable, day rate contracts, we're pretty good. And we can use up to 100% of work or child-related benefits income. Some of those are age dependent, and some of them mean that the oldest kid needs to be no older than 12 when they apply. So what we're trying to do is help as much as we can around affordability, because we know that that's one of the biggest challenges over the last sort of 3 or 4 years, and certainly in the specialist space. There's nothing more demotivating than going to a specialist lender to solve a problem that the high street lender can't cope with. The specialist lender says yes, they solve one problem, but then present another by not being able to go over 4.5 times income. So it's good that we've got a little bit of a win-win scenario there. So any affordability challenges you've got, either on a standalone basis or that you want to use in tandem with credit profile issues or something else that stops it fitting high street, we're the lender for you. We can work with 1 year self-employed. We can use dividends for non-controlling directors. And our definition of a controlling director of a limited company is 25% or more ownership. If you own less than that and you're salaried, we can still use your dividends. Some lenders won't, because they'll say, well, you're non-controlling, which means that you can't control your dividend. And as such, we don't want to take your dividend. So, but our mindset is, well, you're still getting it, so we'll take it. The way we evidence self-employed income is nice and common across whether you're a sole trader or a controlling limited company director. We don't ask for accounts. We just ask for SA 302s and tax year overviews always to evidence income. We also don't ask for business bank statements for the self-employed. So again, not looking to put barriers in the way of lending. And we don't ask for projections. So if you're coming to me because you've got a customer where their self-employed income has rocketed in the last 12 months and you want to use that alone to justify affordability, all we need is the rationale around sustainability. We don't need a projection. You can get one to back up your rationale. More than happy for you to do that, but we won't ask for it. So we won't add that as an extra task as far as processing is concerned. Direct contractors we're good with. We work on current contract times 5 times 48. And I get asked a lot of questions around CIS workers and stuff like that. Our reply really is that if you pay your own tax, you're self-employed. If it's paid on your behalf, you're employed. So that's pillar 2, all about affordability and where we're trying to help with solving people's affordability problems. And the final pillar of lending is all around us being a specialist lender. So stuff that you can come to us for that is for maybe for customers that wouldn't need to touch a specialist lender with a barge pole from the perspective of how well they credit score. They might have perfect conduct, perfect credit. Halifax and Santander and all the rest of them would roll out the red carpet to lend to them as far as sheer credit scoring is concerned. But those customers maybe have an idiosyncrasy of their personal income or employment scenario that means that they need the help of a specialist lender with broader lending criteria. So things like interest only, we can do that up to 75%, and we stress interest only on an interest only basis. You might think that's an obvious thing to say, but many lenders don't. They stress it on repayment. We can go to age 75 using your earned income. As long as the job you do is one we're comfortable you can carry on doing, we'll do that. We're specialists in debt consolidation. We don't limit the amount of consolidated debt. As long as you stick to the 75% LTV maximum we offer on that at the minute, and because we don't have any debt to income maximums, we'll consolidate unlimited amounts of debt. And we'll also crucially not factor that debt back into affordability like many lenders do. We pay the debt off for the customer, so we know it's gone. Therefore, we factor it out of affordability. We'll capital raise for most purposes, including tax bills and non-speculative business stuff. We'll do single name applications for married applicants, whereas some lenders will always insist married applicants apply jointly. Whatever the reason is you want to do it in single name, even though the applicant's married, we'll do that for you. Gifted deposits are fine from immediate relatives. All we need is a gifted deposit letter. We're good with property types that fall outside of lending criteria generally on referral. So ex-public sector blocks, for example, up to 5 floors, standard criteria. Above 5 floors, even those with deck or balcony access, we can look at them on referral. It's all about where it is and what the value is likely to say. Same thing applies with above commercial, studio flats and properties with annexes. And for us, a portfolio of buy-to-lets in the background is self-financing with no extra stressing required, as long as the total cumulative mortgage payments you get monthly exceeds the total cumulative the total cumulative rent you get exceeds the total cumulative mortgage payments. And one thing I've left till last on there, even though it's towards the top of the slide, is that we've got a brilliant fast-track legal service on remortgages on loans up to 750,000. It's brilliant because it's our own firm of solicitors that are based at our head office on the 3rd floor, right next to our underwriters. So unusually, communication between lender and solicitor is brilliant, and most unusually, we instruct them at application submission stage, not offer stage. So the benefit of that is within days of it offering, it's ready to complete. There's nothing worse than getting an offer out nice and quickly with a specialist lender. You're in a good mood, but then you're in a bad mood a few weeks later because it's still not completed. With us, completion happens within days of offer production, and everyone loves that. And the parting thought for you is right here. In a landscape at the minute where there are no exceptions to lending policy in the specialist world, apart from for a case that's already in, no lending criteria exceptions for new business is what the specialist lenders generally are broadcasting, but we're different. We want to lend, okay? We've got a reasons to lend mentality. So if you've got a case that falls out of standard lending criteria, talk to us, because if it's the right case, we'll do it. Thank you, everybody.
Steve, thank you very much. Just so you're all aware, obviously we have packager status with West One across their entire product range. So of course we would love you to come through us to get your cases completed, because I guarantee that whichever mortgage club you might be using does not have as a close personal friend West One's managing director and the underwriter. I think there's currently 3 members of staff at West One as underwriters that I used to work for me. So again, we've got that connection. It doesn't mean we get favors out of them or anything like that. It just means that we've got that relationship's already in place, which, as we all know, is absolutely key sometimes in getting cases through.
Absolutely.
Excuse me. Steve, we've got a couple. There's only actually one question I can probably ask you from the delegates. Nick, you've asked questions about HMOs and buy-to-let, so I'll cover those separately. I'll probably call you afterwards. Neil was just asked, will you accept pension and benefits as income? I didn't see that on the slides. I might have just missed it.
Yeah, pension. I mean, with state pension, we'd want it to be a supplementary form of income. We probably wouldn't lend if it was the sole source of income. But ex-employer or personal provision can be that primary sole source of income. So we certainly lend when there's pension. And as far as benefits are concerned, the stuff that we kind of advertise that we'll lend against would be those work or child-related benefits income. So working family tax credit, child benefit, that sort of stuff. Over and above that, disability income and stuff like that, policy is silent, for want of a better phrase, on that. So if you've got a situation where somebody's getting a different form of benefits income, it's depending on who it's for the benefit of and how long it gets paid will determine whether we take it or not. A good example of that was last Friday. I had a case from a broker where the customer one has been working in a sort of a car showroom on basic and commission, but he's an ex-Royal Marines commando of sort of 18 years service, and he's getting a lifelong payment from the Ministry of Defence after trauma suffered in Afghanistan. So there was nothing written down anywhere about whether we take that because of the bespoke nature of it. So we just basically established the fact that it's a lifetime thing he's going to get. And because of that, we were taking all of it. So anything that falls kind of outside of those classic work or child related benefits income that are written in policy and are easy to find, anything over and above that, get the guys to talk to you, you talk to us, and we can look at it.
That's brilliant. I think the other questions you've already answered. Steve's question about interest only, you've already answered. So, Steve, thank you very, very much indeed. Simon,
no problem.
My son will remove you from the room. as I always say, you might cut and take down the whole show. So just stay there, don't touch anything. Thank you very much. Nice to have met you. I've not met you before.
No worries. Hopefully see you in person soon.
Hope to meet soon. Yeah. So
yeah,
nice
thanks for the opportunity. For everybody that's on, hope the week's been kind to you. Hope the rest of the week's kinder, and hope you have a lovely weekend. Talk to you soon. Thank you.
Excellent. Thank you, Steve.
Bye now.
Right, everyone. We are just going to move on to the last one. Remember, stay on because you could win £100. You've got a 1 in 62 chance at the moment, which isn't bad. We're just going to put on the final presentation, which is. Bear me 1 second. Just going to put that on. Yeah, that's been done. Okay. And we have as our final speaker, who's new to the show, but I have met him and I know he's going to be good because I had a long chat with him and I know he knows his stuff. So we have Amjad Abdul, who does have a slightly different name. I was told it, but I must be honest, I forgot how you pronounce it. So I thought I'll leave it just as that because that's a little bit easier for me because I am in my 60s now and I forget things relatively easy. So you should have received this. This is one of the rare times we can actually send you a product guide, and that's come out to you this morning. So just if you want to have a look at that whilst Amjad's speaking, then by all means do so. A little bit on Amjad. I do love his claim to fame, by the way, which we'll come into next slide. Amjad has been working in banking and finance since he left college at the age of 16, working as a CMAP qualified mortgage advisor for the majority of high street banks, as well as brokerages. He moved into commercial finance in 2016 and has worked as a broker and BDM for various lenders ever since. This unique experience allows him to see a transaction from all angles. Amjad is married with 3 young children. They are a bunch of foodies, so trying new places to eat and different types of food is a hobby he really enjoys. Amjad also plays five-a-side football, which I don't want to mention because that's how I done my groin in a month and a bit ago. And his claim to fame, love this one. Did I do it? Yes, I did. Right. I can't remember how I did. I only did all these last night. Amjad once met a man whilst at a car wash. They got chatting about football in their cars. Amjad said he was one of the nicest strangers he had ever spoken to. A few weeks later, that same man was being interviewed on the documentary Danny Dyer's Deadliest Men. Don't know what channel that's on. The chap's name was Barrington Patterson, also known as One-Eyed Baz. And this is One-Eyed Baz. And he's an absolute monster. If you want to Google him, he really is. He was a football hooligan who I certainly wouldn't have wanted to have come across. He was a monster, an absolute monster. But as Amjad says, one of the nicest guys you'll ever meet. Reformed character, I think, is probably the phrase. Yes. So, Amjad, over to you. Now, you're aware of what we're doing with the prize draw, that we're going to be, because actually that's my next slide. Let me just show, because I did this yesterday or last night. There you go. That's the best I could come up with for a prize draw. We're not quite doing it that way. You're going to be giving me a number when we ask you, and that will actually be a number that's been given to one of the delegates. And we've just lost the delegate, so you won't qualify, whoever you were just left. So it's over to you. I'll see you in about 20 minutes, and good luck.
Thank you very much, Tony, and thank you for having me. As you said, one of my first shows for Specialist Hub, so please bear with me. And also, the delegates before me have set quite a high bar, so I'll try and keep up to their standard. So yeah, good afternoon. Well, still good morning. 3 minutes to the afternoon. So you had a bit of an introduction about myself, which is good. So I'm just going to give you a bit more of an introduction around who Tuscan Capital are and what we do. So Tuscan Capital originally incepted in 2018. It was founded by our CEO and CFO, Colin Sanders and Ed Parsons, who are industry legends. We are also backed by a private equity firm, which just shows the type of caliber and the strength that we have as a company. Prior to 2018, both Ed Parsons and Colin Sanders have managed other bridging lenders and other businesses quite successfully. So just to come on to Tuscan Capital. So why Tuscan Capital? So we are predominantly a bridging lender offering residential, commercial, semi-commercial bridging loans, as well as refurbishment finance. Why do people choose Tuscan Capital? The reason people use Tuscan Capital is one or two reasons, which you can see is either speed or leverage. So back in July 2022, we had a full overhaul of our process following feedback from the industry and brokers like yourselves. And our feedback was to understand what brokers look for when looking for a lender. As in the bridging market, typically, it's always historically been about rates because rates have been historically very low. But what else would they look for? And one of the two things that came about was speed and also leverage. Two things that we offer quite comfortably. And one of the things we did was, like I said, overhaul our whole huge process where we introduced AVMs and desktop valuations. By introducing AVMs and desktop valuations, what that did for us was significantly improved our overall service with regards to reducing timescales to getting credit back terms and reducing completion timescales significantly. And just to give you a few stats, the quickest deal we've completed using our fast track proposition is 7 working days. The average completion timescale now on our fast track is 41 days. We've seen an increase in our conversion rate from application to completion of 38%, and also our increase in loan inquiries as well has been up 26%. And we just had our first anniversary on our fast track proposition. I'll go now into more about our product. So we'll start off with our residential bridging proposition, which is our main focus on our fast track. So within our residential bridging proposition, it includes your single residential buy-to-lets, but then we can also look at your HMOs, multi-unit freehold blocks, etc. And it also includes semi-commercial properties as well. So any asset which has at least 40% residential footprint on a semi-commercial asset, then it falls into the same residential bridging proposition. So we offer loans of up to 75% loan to value, and that's gross loan to values, so it includes fees and interest. We offer both a fixed rate and a variable rate option. So our variable rates start from 0.53% per month, plus the current bank base rate, which currently is 0.42% per month. So rates starting from 0.95, or we offer a fixed rate option, which starts from 1.05% per month. Terms, we offer anything from minimum term of 3 months up to 24 months. Reason we say minimum is 3 months because we charge a minimum 3-month interest period. So that's not to say that a borrower, couldn't pay us back, after 2 months. For argument's sake, it just means that they will be charged a minimum 3-month interest. We don't charge any exit fees or any early repayment charges. It's just a minimum 3-month term. Loan sizes vary from a 100,000 up to 10 million. So we look at a vast array of loan sizes, and we do loan sizes up to the 10 million, typically more so for portfolios as opposed to a single asset. Single assets, we're probably comfortable at around £2.5 million as an individual loan, but as I said, we can offer loans more than that for the larger portfolios. Like I said, within the residential bridging proposition, it includes mixed-use properties, so your semi-commercial, and as I mentioned, anything that has at least a 40% residential footprint will fall into the same within the same category. And borrowing entities, so it's available to your individuals as well as your SPVs, so your limited companies, corporate entities. But we also do lend to trusts, SIPs, SAS pensions. We can look at foreign nationals and offshore borrowing entities. Funding types can vary. So obviously your auction purchase and your acquisitions, refinancing, current debts, whether that be a first charge mortgage or if it's a current bridging loan, we can look at refinancing those. LTVs are slightly different. When we're looking at refinances, we'll only go up to a maximum 70% loan to value where there is a refinance. We can do equity releasing or capital raising for any business purposes. One of the unique things about our residential bridging proposition is the fact that we do allow light refurbishments to be undertaken whilst our bridging loan is in place. There are a few of our competitors that don't allow works to be undertaken whilst the bridging loan is in situ, whereas we are comfortable with borrowers carrying out light refurbishments, whether that be new bathroom, new kitchen, etc. Buy-to-let portfolios, as I mentioned earlier, we're mentioning loan sizes, and then another big one for us that we do is development exits. As I mentioned, it's a big one for us. It's a very popular product. A number of reasons is our loan to value. We can lend up to 75% on development exit, and that doesn't necessarily mean it has to be a pound for pound refinance on the development finance. That 75% can include any equity release for any ongoing transactions. But we can also look at developer exit, where a development is very close to being completed, but isn't quite there with regards to practical completion certificate, etc. Well, what we'll do is we will send out a valuer, and we'll also have an asset manager involved who will assess the scheme and determine how close they are to practical completion, and then we can look at putting them onto our development exit as early as that. So that's just an overview of our residential bridging proposition. So the fast track process, just to highlight, as I mentioned, within the residential bridging proposition, the fast track process means that we can get you credit back terms within 4 hours of receiving the inquiry. We will look at, in the first instance, on pure residential assets, we will look at AVMs or a desktop valuation option. If that is the first route that a borrower wants to take, because we can only lend up to 70% loan to value, we will complete an AVM first. And if an AVM provides us with the right value and the right confidence level, because there is a rating between 1 and 10, and we need it to be at least a 5. As long as we get at least a 5, then we're in a position where we can go straight to instructing legals. If it does come in below a 5, then the second option is then using a desktop valuation, whereby we will have a valuer physically carrying out all the necessary due diligence, i.e. sourcing data from the likes of Zoopla, Rightmove, etc., but also contacting local agents of where the asset is based and getting their market knowledge as well. But at the same time, there is a small fee for that, which we quote at the time of issuing credit back terms. But the borrower always has the option to carry out a full valuation if they want to do so, which will give them the option to borrow up to the maximum leverage of 75%. We do use short form valuations on our residential proposition, which ultimately means it's more cost effective, and a turnaround time is typically 48 hours from inspection to get that report. We use electronic KYC and AML, so we've partnered up with a company called Smart Search, and ultimately what we do at the time of application, we register the borrower's details on Smart Search to carry out the necessary KYC, AML, politically exposed searches, etc. But what happens is the customer gets a notification, whether it be by email or by text message, and ultimately they click on the link and follow the steps. And what they do is they take a photo of their passport or driving license, and their passport of a picture of their utility bill, and then they take a selfie, and it does all the KYC and AML searches for us electronically. and provides us with a detailed report. We will use title and search indemnity to avoid any delays on the legals. Where we, as I mentioned, we lend to corporate entities. Where the loan is up to 65% loan to value, we won't require any PGs, which obviously saves time on the legal aspect with regards to having to get independent legal advice. And we also allow for legal documents to be executed remotely with their solicitors. So if the solicitor has acted for them previously, we will allow for those legal documents to be executed electronically. Our underwriting is asset-based underwriting, because we understand we are a bridging lender. Our risk is more asset-focused. So I'd like to say about 85% of our underwriting is based on the asset. The other 15% is on the borrower, verifying they are who they say they are, etc. And then when it comes to exit strategies, we take a common sense approach. So if it's sale, then we take the feedback from the valuer and their commentary within the valuation report. And then if it's a refinance, then we use Knowledge Bank ourselves. So we will use Knowledge Bank to see how viable an exit strategy is. What that prevents is having you as brokers to then go do research, get AIPs, etc. Because we appreciate that a borrower's circumstances, lenders' products, etc. are going to be very different from now to what they may be in 6-9 months' time. So that's like I mentioned, that's our residential bridging proposition. And just to highlight again, that also includes semi-commercial properties as well. Whereas slightly different, our competitors may include semi-commercial within their commercial product. Moving on to then our remaining other products that we offer. So as I mentioned, we offer commercial bridging proposition as well. Very similar in regards to criteria as our residential bridging proposition. Few things that are different to highlight. So first thing is our loan to value. Our loan to value on pure commercial assets is up to 65%, and that's of market value vacant possession. We require a full valuation at all times on commercial assets. We don't offer desktop or AVMs on commercial property. We look at most types of commercial assets. So what we mean by that is your retail, office blocks, light industrial. We can look at commercial investment and owner-occupied. What we don't do some of the quirky stuff. So your golf courses, equestrian, anything with agricultural ties, that type of stuff we wouldn't quite look at. What can fall, so like I said, criteria is very similar to residential bridging proposition. Now, we do look at, we can consider adverse credit. That's one thing I forgot to mention, and just note it on here. We do look at adverse credit on our bridging proposition across the board. So we will look to see, how does the borrower have any CCJs, any defaults? We will ask for the stories, what's happened, how has that been, how has that come about? And then we will make a decision with regards to whether or not we can proceed, and if we can, at what loan to values. Typically, we would reduce the loan to value from our standard 75%, 65%. We'll probably be looking at around 60-65% if there is a story that makes sense. Now, like I said, very similar to the other speakers, CCJs, defaults, mortgage arrears, that's what typically constitutes as adverse credit. But otherwise, the criteria is same with regards to the term, loan amounts, borrowing entities, etc. So that's that's our bridging proposition. And then our final product that we offer is our refurb product. So a refurb product is anything that's light refurbishment to a heavy refurbishment and some conversions. What we don't do is we don't do your ground up developments. So we don't do anything from the ground up. And we don't do any type of regulated business. So within our refurb proposition, we offer 65% loan to value day one, and we've got to 65% loan to GDV, whichever comes in first. We do look for experience when it comes to refurb, so we would like to see the borrower having done 2 or 3 similar schemes. We do allow, increases in projects. We can appreciate developers want to, maximize on profit, but also gain more experience, increase with regards to the size of their projects. So what I mean by that is if you've got somebody who's done conversions of, converting a semi-commercial to 3 or 4 self-contained units, and they suddenly come to us and they say, right, we've got a similar project, they now want to do 6 units, that for us is perfectly fine. It's when they suddenly come and say, right, I've done units of 3 and 4, and I want to do 20 units. That for us is a bit of a red flag because it's a significant increase in project size. But before we say no, what we do try and establish very early on and at inquiry stage is, who the developers in their experience, but more so the professional team. So who's the contractor? What type of contract are they signing? Is it fixed price? Is it JCT? What level of involvement will the borrower have? Is it just who they are? They will employ a contractor and the contractor takes full responsibility and manages the whole project, or will they have more of a hands-on involvement? So that's what we look for when we're looking at increased project sizes. But when we're looking at refurb products to fast track, obviously, the process, we really need to know the full address of the site or the property, the current purchase prices and market values, what the cost plan is. So, we need to see a detailed schedule of works, detailed cash flow, GDVs, what the GDV is, how they've got to that figure, what the current planning situation is it outline planning, is it full planning, and then a detailed synopsis of the scheme, what they're looking to do, and how they're going to exit us out of the transaction. We can look at, as I said, schemes from inception, so where we need to assist with the acquisition and provide funding for the build cost, we can do that. As I said, we provide 100% of the refurb cost, but we can also look at part completed as well. So if that means refinancing a current first charge there and then providing the remaining build cost, we can do that as well. As I've mentioned, where we don't do ground up development, we can step in on those part completed. So where you have a borrower who's had a part completed development, which is essentially ground up, it's now wind and water tight, they're looking to do just the internals, we can look to step in at that point. Okay, so like I said, anything, so light, moderate refurbishments, we can look at conversions, large extensions, heavy refurbishments. So anything within that space could potentially fall into our refurbishment product. Pricing, it typically is on our refurb product is a fixed rate, because obviously it's hard to determine if base rate changes, then obviously interest is only charged on the balance that is outstanding on refurbs. So to determine what the interest is at that time when base rate changes, it can be a bit of a challenge. So we only offer a fixed rate option on our refurb product. But we do offer a variable product on our commercial bridging, but we tend to see that most do take our fixed rate proposition. just to give you the summary sheets here, just to give you an idea and real life case studies of deals that we've completed. So you can see here we did a developer exit. As I said, loan size on that was 5.25 million, but that was, as I mentioned, it was across a portfolio of properties, so we can do those larger loans if necessary. And then we've got some examples here of some of the refurb products that we've done where we've been involved in the acquisition, also where we've refinanced. And you can see we cover England and Wales. So we don't go into Scotland at the moment. So it's just England and Wales currently. And you can see geography-wise, we don't shy away. So we can go as far north as Barrow-in-Furness and as far south as Dorset and Tunbridge in Wales. And then just a few more examples here of deals that we've completed using our fast track process, where we've completed a deal, 60% loan to value in Newcastle under Lyme. We used our AVM option and no search indemnity and title insurance to allow a speedy completion, and that was completed within 19 working days from application, from inquiry to completion. And then obviously there's the one in Bournemouth as well, which we completed using a desktop a short form valuation. So this was a physical valuation that was undertaken, and that's where the valuer was able to get out to the property and provide us a report back. Was able to get out and inspect the property from 40 hours from instruction, and then provide us a report within 3 days. So there's some more examples there. And then also some further examples as well, just with regards to our geography, because whilst our head office is in London, we do have coverage in the Midlands. So we have a Birmingham office, which is where I'm based from, and then we have a Manchester office as well to provide dedicated support to our brokers across the country. And there's, like I said, some further highlights with regards to how popular and how good how effective our fast track product has been since the introduction and the change to our whole process. And as you can see, there's some testimonials there as well from our brokers with regards to how effective it was being able to use AVM's desktop valuation and everything else in between. And some more examples there with regards to our developer exit bridge, where we provided a loan of 5 million, and it was a loan to value of 72.5%. So we do offer the higher leverages on those. And yes, so that's pretty much everything that I can think of at the moment for Tuscan Capital, and just in the nick of time for 20 minutes there, Tony.
Amjad, thank you very much. Okay, we've not got any questions from delegates, but I've got the questions you set yourself. I'm beginning to lose my voice, which isn't a good sign. You've answered actually most of these whilst you were talking, but one of them is, can AVMs and desktop valuations be used on below market value purchases?
Yes, that's a very good question, and the answer is yes. And that's one of the more so we've had for increase in inquiries is the fact that we've been able to use them on below market value transactions. And just to give you an example, where we are, we lend up to between 85 to 90% of the purchase price, subject to it not exceeding 70% of the value, whether that's a physical valuation or an AVM desktop value. It's whichever of the lower two figures. So the answer to the question is yes, it can be used on below market values, and that's a big plus for us because there are a lot of opportunities there at the moment where borrowers and investors are being able to buy properties at below market value, and also inter-family transactions as well, where it's being sold to family below market value. We can use AVMs and desktop valuation in those instances.
Okay. Martin has asked, do you allow cross charges to increase the day one net loan?
Yes, we do. Yes. So we do first charge and second charge bridging as standalone products, but we also do look at additional security to allow for increased net loans as well. So that's that's also to the point where we can assist with 100% of the purchase price using additional security.
Okay, last question is from Martin again. Do you offer dual representation on auction purchases?
We do not offer dual representation. No, we have our own. We have our own solicitors as well as the borrowers having their own solicitors. But that's to say that doesn't. What we've noticed, it doesn't impact us when it comes to auction purchases because of the changes we've made with regards to using AVMs and desktop valuations, but also the fact that we can use title insurance or no search indemnity, because a lot of the insurance pack and auction packs do come with some of the searches already in there. So we can use those indemnity policies, which saves a lot of time.
Okay. And now the bit that we've all been waiting for. So, Amjad, I need you to give me a number between... We've taken out all lenders that are on board, and any of my staff might be
Damn it, I can't win myself.
You can't win. No, absolutely not, because you're not here. So a number between 1 and 53, please.
1 and 53. Oh, I'm going to go with number 29.
29 is, and the winner is, drum roll please, Lee Williams of AFL Wealth Management. Lee, we'll pass your details over to Tuscan, and they will be forwarding you the £100 gift voucher of your choice. Could you just say that you're here, please, Lee?
And congratulations, Lee.
Lee, are you here? Because if you're not here,
so.
If you're not here, and then we'll have to ask someone. We'll have to call someone else. Quick.
I can see someone is typing.
Someone's typing. Do we have a winner? The excitement's getting to me.
Yes, the suspense is killing me.
I need to lie down. There he is, Lee.
Yes.
Nice one. Congratulations. You just won yourself.
Lee, thank you very much. Congratulations.
Amjad, thank you very much indeed. Simon will, again, you're probably bored of hearing this. Simon will take you out of the room so you don't close down the whole thing today. So thank you very much. I'll see you again soon.
Yeah, thank you very much for having me, and thank you all for watching and listening.
One thing I just should have added, actually, with regards to Tuscan, is that we have packager status, as you would expect, but also, and hate to name drop, but Colin Sanders, who Amjad mentioned, has been a close personal friend of mine now for about 35 years, and close enough to attend weddings of each other. They came to my wedding, and we've been very, very close friends ever since. He's also doing one of our Sutton specialists in November or December. We just haven't decided on a date or what we're going to be talking about yet. But that's, again, a massive help, because if we have a problem, I can just speak with Colin, and he's the guy who makes the decisions because he owns a company. So this is on to me. I've just realised I'm going to have to move my microphone, because otherwise I can't see my screen, my new Chinese, whatever it is. So let's just move that out of the way and put that there in front of me so you can hear me. Right, this is very different what we're doing today. I'm waiting on my slides to be loaded. Hopefully they'll be up any second. I can do them now. Okay, yeah, they've just come up. Great. Okay, so this is really what I want to talk about today. Is my first slide. I'm going to be talking about regulated second charges, unregulated buy-to-let second charges, and regulated bridging loans. So this is something very new. And I was up till 2 o'clock this morning writing these and checking them, checking for spelling mistakes and trying to make sure they made sense. But I was so knackered at the end of it, I'd probably let a little bit slip through. So please bear with me. We can talk about regulated second charges first. If I was ever on Mastermind, because I've been doing this 40 years in September, this will probably be my specialist subject. So if you have any questions whilst I'm talking about regulated second charges, please feel free. If I don't know the answer, I'll just say pass, and I'll come back to it. But it's really, I'll start this with, are you missing out? Because quite simply, with the way things are at the moment in the mortgage market, with rates ever increasing, stress testing, and everything else you're having to experience. And we've seen some horrendous things in-house. And we had one guy who started his process, I think it was January of 2022 when he first came to us. How much can I borrow? Which we always hate saying, because obviously it's subject to change and products disappear. And it was around just over 700 grand. When he found the property, I think it was August or September, that had reduced to below 500. So that's how much things have got worse, much, much worse since then. What we're experiencing at the moment is probably equal to what we were seeing last October time. And it's not something I've come across before in all the years I've been doing this, where we've had increase after increase after increase. But it is what it is. But this is where second charges come in, quite simply, because we've got 16 lenders on panel. because of my length of time in the industry, and again, it's a situation where I know most of the directors at the level of director level are lenders, quite simply because they all started at much like BDMs or underwriters 30 odd years ago, and they've just stayed in the industry and just moved on up, and now in a decision making role. So that's very, very advantageous to us. If those 16 lenders we've got, as it says there, we've got another lender launching for us exclusively who is actually watching today. And 2 more launching once their FCA permissions are granted, which is, I'm told, in the very, very near future. If you're using the mortgage club for your second charges, you're probably not doing the right thing by your client, because I guarantee no one at those mortgage clubs knows the people we know or employs the people that I have and can do what we can do, because most of them, they'd be lucky to have access to 4 lenders. So affordability. We're all experiencing the affordability problems. That's the major issue at this moment in time on what's happening. And it's something we're all seeing. With second charges, Steve Mannakee from West One mentioned it on the first charge side, how that's 5 times, but they can go above that on certain products. Well, the minimum we have is 6 times income. That's for about 4 or 5 lenders. The rest of the lenders don't have any income multiples whatsoever. Just don't do it. So that's a major, major advantage. It's based purely on affordability. Lenders tend to use ONS stats. Got a couple of lenders who will actually use what the client says. Of course, it has to be sensible. If you've got a married couple with 3 kids and they say they're spending £50 a week on food, I will probably dispute that. So it has to be sensible, but it's not. I mean, ONS stats are okay, but I don't know if you're aware that if you own a mobile phone and you live in Newcastle, it's half the price of owning a mobile phone if you live in London. That's according to the ONS. Couldn't make out, could you really? And that's what lenders are going with, and that's what lenders are using. So if it's most lenders will allow the ONS stats to be overridden if the clients are paying less, or there's a situation such as self-employed and they've got a company van, but it's in their personal name, that type of thing, that can also be taken out of the equation as well. So lenders are much more sensible when it comes to affordability when it comes to second charges. Security and loan to values. I've used a couple of examples here which you might never have come across, but literally in second charges, it's all types of construction types are acceptable, unless the thing's falling down, unless it's condemned, unless it's something majorly wrong with it. It can be done. So high-rise flats, non-standard construction, ex-council balcony access. And I use this last one because this was actually a deal we did a while back. But I actually went and saw the client, and the property was made from steel from scuttled World War II warships. And you could still see the rivets in the side wall. And there was about 4 of them on the street, and they stood out like a sore thumb, but we were still able to do it. So it's literally any type of property at all. Lenders willing to go up to 100% loan to value, sometimes even more. And that might sound, those of you who have been in the market a long time, you might remember the First Plus, lender called First Plus, who were doing 125% loan to values, and the outrage in the financial press, who really shouldn't be allowed to publish what they publish half the time, as the products like that being there. Well, all of those products that First Plus were writing, they didn't have any arrears whatsoever because they had their scoring system was spot on. But secondly, those clients that we saw that started borrowing in 1997, 98, 99 at 125%, within 3-4 years, they're at 85%. So it solved a problem for the client at the time. But at this moment in time, we're not back where we were there, but we have lenders now readily going out to 100%, which is a major advantage. And on 50% of the cases over 50% of the cases we now do, a home track valuation is all we require, which takes probably about 30 seconds to obtain. So there's no physical valuation being carried out, so obviously fewer delays. So again, a major advantage. Adverse credit history, huge flexibility on CCJs, defaults, existing mortgage arrears. Some lenders ignore anything over 12 months old, whether it's satisfied or not, regardless of what the situation is, just huge flexibility. Debt management plans can be left in place with most lenders if it's up to date. Lenders will accept all types, previous bankrupts. I've even done a case once for a client who was in the process of, he had a pending bankruptcy order against him, and we managed to get that through fairly easily on that particular deal. And most second charge lenders do not credit score, which is also another major advantage. As Steve mentioned earlier on, if you're credit scoring and you're looking at adverse, you're giving the client a double hit as far as the underwriting restrictions are concerned. So most lenders don't bother with the credit score because it's absolutely pointless. Because what's it telling you? It's just telling you really the credit score is based on their credit. And you can look at that separately. Debt consolidation, over 80% of second charges are used to consolidate debts, which is, I don't think that the first charge market is anywhere near that, because most first charge lenders aren't keen on debt consolidation and don't have the capability of actually repaying the debts directly that second charge lenders do. And this is something the FCA has been very hot on. And I know of examples before this was brought out. I can remember there was one guy that we did a loan for, and he got, I think it was about 20 grand, and he took it down the casino that night and lost a lot. Now, he was supposed to be consolidating his debts, supposed to be repaying his credit cards. He didn't. He went and decided to gamble it and try and double it. Well, it didn't happen, unfortunately. But lenders now repay all debts directly. So the client is then left with a clean slate. And hopefully they won't get themselves into the same trouble, but we know clients quite often will do. And with financial pressure from increasing mortgage rates and all the bills that we're all experiencing, my electricity bills gone up, electricity and gas bills gone up, I think about 5.5, 6 times in the past 2 years. It's pretty horrendous. It's got to the stage where I'm only allowing my son to have 1 shower a week, for example. No, I'm not. That's not actually true. But I'm sure there are people. I've been speaking to people, and they're saying everyone they speak to is really finding things tough at the moment. And we're in a situation. You see the last bullet point there, where we're seeing clients that have come out of COVID, and I call this the 9/11 effect. Now, those of you in the industry all the way back in 2001 and before. At that time, we was probably just around coming to our peak. We had well over 120 staff. We was running a very large business. We was one of the largest second charge brokerages in the country. And in 2001, we started to see a dip in business. I don't know what it was, but just probably from about March, April onwards, there was a dip in inquiries, a dip in completions, to the extent we were looking to make some redundancies. Then 9/11 hit. And we thought, oh, Christ, it's going to get worse. And completely the opposite happened. So we started talking to clients just to say, what's made you borrow? And pretty much everyone we spoke to said, I might not be here in 2 years' time with the way things are going. So I've just started to enjoy myself in the meantime. And it literally just went crazy with inquiries and people looking to borrow, because they just thought, sod it. What am I waiting for? Why am I putting off doing what I want to do and for another 2-3 years? And very much the same, I think, has happened in COVID. People were obviously very concerned about COVID and the effects it was having on basically everybody all over the world. And they just thought, since that, you know what? I'm gonna buy that hot tub that I've been promising myself for the last 5 years. I'm gonna do this. I'm gonna do that. I'm gonna go on holiday to Mauritius. I'm gonna do whatever I want. And they've run up some debt. And all the credit card debt, because it was fine then, because rates were sitting at 0.5%. Now rates are at 5%. And people are finding it very, very, very tough. So debt consolidation, you will have clients out there that you could be the lifeline that they actually need. So if you're not talking to your clients, honestly, I strongly, strongly recommend you do so. Because sometimes they're too embarrassed to actually come and say, look, I'm in problems. They'll just go on Google or listen to an advert on the radio and end up in a debt management plan or something daft like that they don't really need to be doing. So speak to them, because this could be exactly what they need at the moment. If you can't remortgage them, this could be what they're actually after. And buy-to-let second charges. Are your clients missing out? I got a good example of this. I had a call from a broker yesterday. I took the call. The phones were going mad, so I took the call. And the broker said, I'm trying to raise some money for my client. I need to raise 300 grand very quickly they're buying a business that has some property, but they need 300 grand extra to complete the deal. Okay. So what have they got? Well, they've got lots of buy-to-lets, but they're all on long-term fixed rates. So they don't really want to remortgage. Is there anything else we can do? So we are now doing a second charge on their house and 6 buy-to-let second charges to raise the 300 grand. And we'll do as much as possible on the regulated second charge, because it's slightly cheaper, and then make up the shortfall. So this is where we can use a product to get a client what they need. And once they bought the business that has the properties within it, they can then look to refinance away from the current borrowing that's in place, that is going to stay in place, and repay down or pay off what we've arranged for them. But as it says there, if there's many clients, if there's ERCs, or just face it, how many of your buy-to-let clients now, when they come to end of term, are going, just give me a product transfer? because they're not going to qualify for anything else. It's much more flexible on second charges when it comes to the income. Top slicing is readily available, and it just means we're getting through clients who really have got no option unless if they didn't know about second charges, or their advisor doesn't know about second charges, they got no option available to them. So what they do, they go on Google, because they'll still want to do the deal, and they'll go to somebody else. Currently 8 lenders offering second charge buy-to-lets, prime to major subprime. And again, I'll keep banging about mortgage clubs. I do wonder why mortgage clubs exist at times, because I don't see the benefit they give us other than taking 10% of our income for doing absolutely nothing. You'll be lucky to access 2 if you go through a mortgage club, if that. Say we've got currently 8 with more on their way. How we source our second charges. I mentioned about our commercial quote system. We decided quite some time ago, all the way back in 2016, when the second charges became regulated by the FCA, that what was out there as far as sourcing was concerned, A, wasn't fit for purpose, and B, was dominated by one broker that was driving a lot of business to that broker. Now, of course, that broker, if you're not aware, has recently been bought out by the largest mortgage broker in the country. So your clients now are obviously could be sitting with a company. If you're using one of the sourcing systems, they could be going to a company that is a mortgage broker and also protection broker. Not saying they're doing that in any way whatsoever. I'm not saying they're actually doing it, but just be aware. So we developed Loan Quote. Loan Quote, quite simply, looks at the entire market. Every lender's on there. It's updated by me. It was designed by me. And the reason I did that was, if I'd given it to an IT person, it would have been zeros and ones. When it comes to loans or anything that we do, we know it's not about zeros and ones, because quite often it's not. The clients just don't fit on the information they give us. It needs some flexibility. So we've built that flexibility in. So it means that we can actually give an accurate quote within about a minute of receiving the information that we get from you. So you can just phone us up, give us the information we need, and yet we've got 4 lenders. This is the rate, this is the terms, this is the repayment, and you can go back to your client and give them the advice if you wish to, or pass it on to us and we'll do that for you. It's more accurate than the 3 sourcing systems because we've tested against it, and it's updated sooner. So hopefully no lenders have changed their rates this morning, because I can't do that until probably about 1:15. But normally we have these updated within 20 minutes of a change happening. So it's live. I've seen stuff on one of the sourcing systems of 2 weeks after a lender made changes, it was still quoting old rates. And of course, it's quoting rates that were lower than what was actually available. So that's how we source our business. I better have a little bit of water. If you wish to advise on second charges, it's a complex market. I mean, it's not easy, you must admit. If you've never done a second charge before, you might not know how to obtain consent to a second charge. Is one of the issues that we sometimes come across. And obviously, you're not going to have access to all the criteria of every lender. Well, we can help you access, if you wish to advise, we can help you access every lender in the marketplace, source the best product using our software, help you with file compliance, instruct surveys, and issue consent requests on your behalf, package the case on your behalf, check all documentation, pay you the income on the day of loan completion, no loss of control, no package fees. And we have a lot of broker partners now taking advantage of this, giving the advice because it fits in with their business model, and their client isn't being charged up to $5,000 for the privilege as they are by other master brokers, my most hated term. But that's the product we have. No package fees whatsoever. We don't charge them up front. We don't charge them on completion. For the smaller deals, we keep the proc fee. For any deals over $50,000, we normally pay you a slice of the proc fee as well. But you get the benefit of us knowing exactly what we're doing. And the next slide would tell you just how good we are at what we're doing. But because we're being told by broker partners that are using us that we are the best I've ever come across. So here's 3 I pulled off of. It was very late last night, but I pulled these off of Trustpilot, and I won't read all 3 of them. But when you have if your client is saying to us, and then we're passing it on to you to say it is not an exaggeration to say that you are a tremendous person, you're not going to get a happier client than that. That was the 3rd of July. That client's loan completed, and as you can see from all of those, would definitely use again. And that's one reason why we've got pretty much 5 stars across the board on Trustpilot from all the clients that have actually posted something that Trustpilot have actually agreed is not a fake review, which is the other problem we got with Trustpilot at the moment. But that's the type of feedback we get. We don't get bad feedback. Just don't get it. You get bad feedback on lenders, but not on ourselves. Second charge panel, I'm not going to go through all those, but as you can see, considerable amount. I can't even 3, 6, 9, 12, 16 lenders. So that's exactly what we have. More coming to us shortly. So watch this space. But we deal with everybody. And that's the advantage we've got over so many others out there, and so many other packages I've seen that have come into the second charge market over the last few years. And I was on a seminar once when one of them, I won't say his name or what the company was, and I said, how experienced are you at second charges, knowing they'd only been doing it about 15 minutes? Oh, yeah, we're really good at it. How many lenders have you got? 3. Okay, fine. Okay. And they are getting significant amounts of business with no panel because they don't actually know what they're doing. So that's who we deal with. It's literally everybody. And when lenders do come to market, as I said, we've got one that's coming to us exclusively and another 2 that want us to go on the pilot because we are good at what we do. How much do you get paid on a second charge? If we give the advice, we pay you 4%. Now, this may change with Consumer Duty. We're still umming and ahhing at the moment as to what will happen and what our charging scale is going to be. You get 4% in advance up to $2,500 because commissions and broker fees are capped on second charges, paid on the day of completion, always. If you've got your bank details and you give me the right bank details, that's another problem we have at the moment. We keep getting wrong bank details and wrong sort code, for example. We pay on the day of completion. If you want to give the advice, 100% the fee you charge fits in with your fee structure. We don't have any say in it. If you want to charge 395 quid, great. If you want to charge £5,000, great. Your choice. You have to be authorised to do it, of course. You have to have the permissions to give advice on the second charge. Again, we pay you a share of commission, as I mentioned, paid on the day of loan completion. Regulated bridging loans, not going to cover too much on this, but it's one of those situations we're finding so many of these inquiries are now coming through to us. People that have just decided that with the way things are, I mean, my situation, for example, is myself and my wife, when we moved in our house 16 years ago, I have 4 kids living there. One's about to be married off. He doesn't live with us anymore, but he's about to be married off. I've got my youngest son living with us at the moment. He's shortly going to be moving to Manchester. With a job. So it'd be myself and my wife rattling around in a big house with big heating bills, with big maintenance costs, everything else. Do we want to stay in that? Lovely area, but we'll probably try and downsize to something. We can afford actually, when we sell it, we can just then buy something mortgage free, which would be great. Many people are finding they can't do that. Many people also find they find a dream property they want to downsize to, but they're in a chain. So what do? They take a regulated bridging loan. And this is another area, but because there really isn't anything out there, if you want to source these, by Christ, is it difficult. So what we did, we designed BridgeQuote. Well, I designed BridgeQuote, which can help source regulated bridging loans. And it just helps us to immediately be able to give a client or a broker partner an indication of exactly what is available from the marketplace to them. Immediately, within 60, 90 seconds. We've got others taking second charges to refurb their house before they sell it because maybe they want to bang and they landscape the gardens, for example, just to tart it up because they think they'll get a higher price. And second charge bridging, sorry, not second charge, but regulated bridging can be used for literally any purpose, as long as there's a legal purpose. We've had clients take money to pay a tax bill, to pay a VAT bill, all sorts of stuff. So they can be used for pretty much any legal purpose. And that side of it is probably accounting for 50% of our market, our bridging deals at the moment. And it's a massive part of the market. If you're not doing it, then it's something to consider. If you're not happy with giving advice on it, because we are talking rates that are not the same as obviously a regulated first charge, we're more than happy to give the advice on your behalf. And as I mentioned, how we source it, BridgeQuote, again, designed by me, updated by me. When my wife's watching I'm a Celebrity or some nonsense on the telly, which I can't stand, I'll just sit to one side or at the table and get things updated. If it's during the day, they'll be updated within 20, 25 minutes, excuse me, of the release of the press release. So again, more accurate. We've also tested it. It actually does show exactly what the lender calculators does. So we've tested it against the lender calculators, so we know it's quoting the right figures. And of course, it's whole of market because these are our regulated bridging lenders. Pretty much everyone that you can think of that's in the regulated bridging market. Some dip in, dip out from time to time, but that's everyone that's currently lending we have on panel. Our service, packaged or introduced only, you choose. Quite simply, if you're not limited, you don't have to only give us introduced business, or you don't have to only give us business that we package on your behalf. You can mix and match. You decide entirely. We offer enough products that you can decide. If you're more comfortable on advising on second charges, but you don't want to advise on bridging, then absolutely fine. My team are geared up. All of my staff are trained to deal with cases, whether they're giving the advice or whether the broker partner is giving the advice. And then exactly, we don't have separate departments for it because it's pointless. It's the same product, slightly different circumstances. We're not talking to the client if we're packaging. So we've done it that way, so that there's continuity and you're dealing with the same people each time more than anything else. Why we're different? Really, I'm losing my voice now. It's not the products we offer. We offer pretty much the same products as everybody else. Occasionally, we do get exclusives. Occasionally, we do get pilot, like on the pilot launch of a particular lender. But pretty much we offer the same. It is the people we employ. Now, I've been very strict in this over the years. I've employed a lot of people. I've done a hell of a lot of people over the years, probably well over 1,500 people in all the years that I've been running businesses. And I began to understand when things got really big, how weak members of staff can really drag down an organisation. And I see it every day when I talk to lenders. And I've had a conversation with a girl this morning at a lender, and I've mentioned before, it was horrendous, absolutely horrendous. It's like she just walked in that morning and was asked to pick up the phone and asked to give details on what criteria was available. She had absolutely no clue whatsoever. So I insist a minimum 5 years specialist finance experience before they even get to an interview. Absolute minimum. They must be mature with life experience. It doesn't mean I discriminate, but I prefer people who've actually got a bit of life experience, so that when you are phoning our office and speaking to one of my people, you will feel that they know what they're talking about, and you won't go away from that conversation thinking, like I did this morning, by Christ, I'm losing the will to live, because I really was. And on the rare occasion something goes wrong, because we're all human, they recognize it early. They'll know when something's gone wrong and they deal with it. They won't hide. They won't sort of brush it under the carpet and hope it goes away. They realize that if there is something gone wrong, it's very easily to rectify things if you deal with it early or you deal with it properly. And that, again, is very, very important. Our lender relationships, I'll keep banging on about how long I've been doing this bloody job, probably until the day I leave it. But it does make a huge amount of difference when it comes to getting cases through. Because I don't tend to deal with the underwriters at lenders on cases. I deal with the hierarchy, who I'm usually well known to, almost always well known to, or have some form of relationship with. And that can pay dividends. And we all know how much easier it is if you're actually speaking to somebody on a case who is one of the decision makers, for example, but also because you can have an underwriter go to a decision maker and they'll give their version of what the deal is like, which might be different to your version. So speaking to the decision maker directly just means they're getting my version of the deal rather than someone who doesn't want to do it, or doesn't like me, or doesn't like a member of my staff, or just doesn't like brokers in general. And there's plenty of those out there. It's how seriously we take compliance and prevention of financial crime. We're very, very hot on that. We've been told by the NACFB we have by far the best AML and KYC procedures of all the brokers they have. We've told that now 3 times. And it's not our numerous source in the financial press. I will never get in the wall from the financial press because I'm far too critical of the financial press and the award system. Great for lenders, brokers. It's as bent as it comes. It really is at times. What else can we offer? Designated underwriters from start to finish, unless it's a case where we do have a solicitor involved, which is an absolute nightmare, as we probably we all find from time to time. In which case I get involved because I have absolutely no problem whatsoever in telling the solicitor that they will be reported if they don't do their bloody job properly. And there's plenty of them out there at the moment who are doing exactly that and charging astronomical fees for a poor service. I don't know how they get away with it sometimes. So that's now part of my job, is to really rip into solicitors when I need to get them to actually talk to each other. It's quite often the most difficult part, actually talking to each other. But just do their job, and I'm all over them like a rash. Commission paid immediately on when the loan completes, and there's no clawbacks unless it turns out to be fraud, and that hasn't happened in so long I can't remember, or the client cancels with any sort of like any sort of cancellation period, like 14-day cancellation period. Some lenders have. So basically, that's how we work. But I don't wait to get paid to pay you. Quite simply, as long as I got your bank details, I'll pay you. My 60th birthday was 2 weeks ago yesterday. I paid 4 brokers on my 60th birthday. 2 of them I paid, and I'd had far too much champagne because my kids all came around and bought me bottles of champagne. But I still paid, and thankfully I didn't overpay them or underpay them. But that's the way we work. I will pay you when I've got your bank details. Our products, literally everything. I've added one more bit to this, which is probate loans, which we've now started offering. We've now got a panel of probate loan lenders, which has proved to be quite useful. And we now have a number of solicitors that are passing business on to us to help assist in either raising inheritance tax, pay off inheritance tax bills, or for those clients who want to take their inheritance early. And the most recent one we completed, actually, I think was last Friday, and that the broker 1,500 quid. He did literally nothing. 1,500 quid paid on the day alone completion. So obviously very happy, and a happy client as well, because he needed the money for business purposes because things are getting a bit tight for him. If you want to submit a case, you could various ways of doing it. You can go to the type your message box below, complete the decision in principle form that will be sent to you on email today. You probably, if you've been before, you probably already have one of those. They can be downloaded from our website as well. You can also submit cases on our website. You can submit them online; they come through to us literally immediately, or call the team on the free phone number or the direct dial number. Entirely up to you. I am going to ask actually if there's any questions, because one thing I did forget last night was to put a question slide on. So I think there might be. Andrew said, interested to know who that is. Sorry, Andrew, I don't know at what stage that actually was that you've asked that question. Our network has just moved to Xplan. I don't know. Yeah, I'm not sure. If you can maybe ask that again. Okay for non-specialists, but that's it. Well, okay. Well, name my company is Specialist Financial Services Limited. I recognised 20 years ago that the market that I was operating in was something that normal, that usual mortgage brokers quite often didn't even see at that time, or didn't even touch. But that's how I set my company up, and that's what we do. We do the stuff. We can do the easy stuff, but by Christ, we do the difficult stuff as well. There's no more questions. If there are any questions, just ask them. I'll cover them right at the end. But if you are on LinkedIn, you should have received an invite from me if we're not already connected. If your name is John Smith, Paul Jones, anything like that, you've got a very common name, it's very likely we couldn't find you. So don't take it personally, but there's not many Tony Suttons on LinkedIn, and we've probably got mutual connections anyway, so you'll find me quite easily. So please request, and also follow the Specialist Hub page, because a lot of our updates now are being launched on that. If you've liked what you've seen today, you're not already registered with us. If you register with us online, you've actually already completed an agency application form and signed the terms and conditions. If you want to do a paper version, this will be sent to you today as well. We do need this to pay you commission. I don't need it to receive deals from you. But that's very important, because obviously it's an FCA requirement that we have some form of agreement with broker partners that are putting business through us. So get that over to us as soon as possible. I do have a bit of a backlog on these at the moment because I have just returned from holiday. So forgive me if you've not heard from me. You can give business to us, and it's very, very rare that I turn somebody down. Very rare. I'd only turn someone down if they were acting as a mortgage broker, a regulated mortgage broker, but they weren't actually authorised, which you come across occasionally. And I won't deal in that situation. Next Specialist Mortgage Web Show is lots of banks actually presented this one. Castle Trust Bank, Shawbrook Bank, Tandem Bank, and good old Together, who are proven invaluable at the moment for the business that we're writing. A lot of business being put through Together that literally could not be placed anywhere else. We have packager status with them, packager status with all of those lenders. So please, you can sign up to that. I'm not sure what they're all talking about. I'll cover that obviously next month. The future ones, September, October, November. Register for as many as you like. And I do need to make one change, actually, because I mentioned that Roger Morris was, I think, presenting we're doing the Sutton, the Specialist, on the 30th of August. It's actually the 23rd of August. I was looking at our website. As unfortunately, the change was made whilst my head of IT was in hospital. So he's actually now made that change. So it has actually moved to the 23rd of August. I think it's the 23rd, probably even the 24th of August. Check the website. It's on there. I can't remember. But all of these bits, you will see now, any second now, there will be a box appear. I'm hoping a box appears towards the top of the screen that looks very much like the click here and leave feedback and download give. Don't click on it yet. But when you do, you will then access, first of all, our feedback form. Please complete the feedback. Really do need it. Also give feedback on what my second presentation today, please, because that's going to be very handy for me moving forward. If it's something you want me to continue doing, filling in the gaps of what you haven't heard about, I'm more than happy to do so. And talk less about what we can do. You know what we can do, but talk less about that and more about what you can potentially get through, because that's what earns you the money. And all the forms that you need, the GDPR compliance forms, the product commission and proc fee document, all downloadable. There's loads of others as well. CPD, email to you, as I mentioned earlier on, email to you by close of business tomorrow. Please check your spam before you call us and say you haven't received it, because probably 99% of cases they are sitting in your spam folder. If it's not, just give us a call or email and we'll get that over to you. Again, should be fit pretty much immediately. Feedback, leave feedback for us. Today's show, obviously, it's free to all of you. It's free to all lenders as well. We don't charge for this. Unlike the financial press, who quite often will charge ridiculous. I mean, I'm talking £1,000, 1,500 quid just for somebody to talk for 20 minutes online. They're charging a fortune. We do these all for free. Please leave us a review on either Google or Trustpilot. Hopefully it'll be a positive review. I've just seen Lucas. I did. Yes, that's my fault, Lucas. My apologies. That's only because I've just returned from holiday and I have to sign them off, any brokers. But I will be doing that this afternoon. So again, my apologies. Thank you to today's sponsor, which was Lendco, the best lender you've never heard of, or the best lender you now might have heard of. But thanks to them. Again, any Lendco cases, give us a call, because I guarantee we'll get through more than you can if you go direct, because of relationships. And enjoy the rest of your day, and thank you very, very much for attending, and hopefully we'll see you again soon. I'm going to go and rest my voice because I've been talking now for what feels like about 4 or 5 hours. See you again soon. Bye-bye.